Hello, my dear future chartered accountants. Hope everybody is doing great. This is CA Chinmaya Hegde, your learning partner for CA Final, FR and AFM. Since a lot of students have requested what are the specific amendments applicable for May 2024 in AFM, this video is on these topics. It's applicable whether new syllabus students or from old syllabus to new syllabus, whoever rating from May 24 onwards. So study material, what are the topics that they have added is what we are going to focus on in this video. Let me give an overview first. In the study material, in the financial policy, they have added this topic called as advanced role of CFO in various matters. Let us discuss about that along with the study material in a moment from now. Advanced capital budgeting, the whole chapter is a new one and for which I have added about 9-10 hours detailed video in my YouTube channel. Check for that detailed discussion on capital budgeting, which will not be covering in this video. Security analysis, they have added one small equity research and tools available. They have just given a list of application software available, not going to be that great relevant, but still we cover it. Security valuation, they have added role and responsibilities of valuers. You know, even as per Income Tax Act, Companies Act, merchant bankers, so many valuer profession have taken place. So many valuers associations are there. So what are the responsibility, precautions to be taken by valuer before accepting any valuation assignment? That small like a duties and responsibility have been added. Securitization, they have brought in the concept of tokenization, which is used a lot, with respect to all these PTMs, all these UPI transfer, the concept of tokenization that has been discussed in the context of securitization. In portfolio management, gold, that is, what is the importance of gold, which is a natural hedge against inflation, how is going to happen, and what are the modes of investing in gold. Of course, you can have physical gold, but you can also do it through things like sovereign gold bonds, SGBs, things on that line. Then in mutual funds, evaluation of mutual funds, role of fund managers in mutual funds, and role of FIIs in mutual funds. In the current day context, mutual funds have taken a great position in the institutional players. It's a combination of institutional as well as individual, because the flow of money for mutual funds comes from retail people, but the decisions are taken by the mutual fund manager, the AMCs. So that's an interesting area. They've added few topics such as the fund manager's role and also about FIIs. Then derivatives, they've added some new types of derivative options like exotic options. First of all, options itself is exotic for most of our people like us, and they have given exotic options. Amazing. Credit derivatives, something like a credit default swap, CDO, then synthetic CDO, which used a lot in 2008 global economic crisis, subprime lending crisis. And this has got connection with securitization also. So be aware of the basics of securitization before we come to the concepts on the real, the credit derivatives. Real options connected with capital budgeting, weather derivatives, electricity derivatives, derivative mishaps and lessons. Certain case studies have been introduced. I don't think they'll ask that question in exam, but let's quickly run through a couple of case studies at least when we are discussing. As far as foreign exchange risk management is concerned, role of SWIFT in foreign exchange, national international payment, the cross-border payments. So some technicalities have been added, and some popular derivative products in Forex, which you know already, like you can take position in the futures, long short, options, call put or long short, they have discussed in the context of Forex. In international FM, International Financial Center have been introduced, which was a chapter couple of years back in the new syllabus, which was taken out, and now they are adding it back. Anyway, they like this going back and front. That is a natural phenomenon by our institute. Gift City, which is in India, situated in the place of Gujarat, lot of benefits are there, international standards, infrastructures are there. In this context, some theory have been added. Sovereign funds, like we have Kuwait Investment Authority, there is a lot of the sovereign funds, meaning government functionalities also do investments. In the context, few theory points have been added. Interest rates, LIBOR is what we used to use as benchmark, and then has something called as ARR, or then something called as SONAI. So like that, quite a few methods of benchmark rates used across the world. Introduction has been given. Business valuation, quite a few topics have been added, because in the current day context, valuation is the game, right? Like if you talk about companies like Byju's, never made a profit, Zomato, Swiggy, still they are getting listed without any profits. So they are going against the traditional mode of valuation and traditional mode of business, and therefore they require a separate discussion in the study material which they have added. Valuation of distressed companies, when they are suffering, they are likely to close down, like Byju's in the current day context. Startups, they just started, banks don't give loan, venture capitalists will give loan. So how do you assess the initial stages of companies? Valuation of startup, valuation of digital platforms like Facebook, even Unacademy, those kind of things. Professional firms like CA firms, if you want to acquire, or like CA related services, like who provide merger related services, professional services, if you want to acquire, or let's say a hospital takes over a clinic, that's also professional service, those kind of things. Impact of ESG, environment, social, government, is a buzzword for a couple of years, and what is their role in the valuation of companies and business. And as far as merger is concerned, unlocking the merger through mergers is the chapter name, and how you can unlock the value through business restructuring. So this one new element has been added, by doing horizontal merger, by doing vertical merger, how the business value can be unlocked. For example, Reliance has done the demerger of Reliance Jio, and that has got added value to the shareholders. So things like that, how the valuation can be unlocked. Valuation was there, how it can be realized with the help of merger techniques. And they've also added in one concept called as special purpose acquisition companies. That's also, I think, is a new addition being added. And as far as startup is concerned, the concept of unicorn, where the valuation, is crossing $1 billion, and succession planning. The current generation, how it is being successfully being continued by next generation, the planning activities for such smooth transitioning is covered in successional planning. Succession planning in business. Okay, success is not so easy, my dear friends. So pronouncing succession planning is also not easy. Okay, great. So this is the brief coverage of the overview. Now let us get into the individual topics one by one. Okay, so the first chapter is financial policy and corporate strategy, and first topic being advanced role of CFOs in various matters including value creation. So what is the typical job of a CFO, Chief Financial Officer? To prepare MIS reports, take it to management, take the decisions relating to compliance, starting a new business, basically providing insights, making sure compliances are there, financial statements are prepared, coordinate with the appropriate people. The traditional CFO is responsible for financial wing of the organization. The advanced role is going few steps further. You have to take care of the risk management. Risk management in the sense, it is not just about the financial aspects. Like for example, Paytm is into big trouble because of compliance issues. And you have risk analysis chapter also, right? Risk management. We have various types of risk: counterparty risk, government risk, that is sovereign risk or political risk. So it is not the job of a CFO just to look after the financial wing, but overall risk of the organization. What element could bring in trouble to the organization, be it affiliation with the parties, taking necessary approvals, evaluating what are the technological changes taking place. Like there may be artificial intelligence playing over important role. Please have a discussion how it can impact the organization in the long term. CFO is not just expected to look at the financial wing, lot more related to risk management, supply chain. As the institute also told, supply chain has gone tremendous changes after pandemic have taken place. Because of the lockdown throughout the world in various countries, ships were stagnant, transportations were not happening. So demand was there, people wanted products, but the smooth transportation was not happening, due to which there has been a stoppage of supply of goods and services. So there is a shortage between supply and demand. So supply chain constraint, how to get the material, how to get the factory smoothly running, how to get the labor. So CFO has to be involved even on those matters. Merger, acquisitions and corporate restructuring, I think this is anyway even part of earlier also, but in recent times the mergers have become more very frequent. That is one of the inorganic way of growing, because I was part of one of the mutual fund distributors. I don't want to name it. So they had got few thousands of customers, but they had got the valuations, and for which they want to show more customers. In next 3 months, they had to show more customer, but they are not able to. So what they did? They acquired one company. The company had existing set of customers already. So they could show, oh, we grew by so many times. That's called inorganic growth. So you can take loan, you can do acquisitions. So see, these are the things, the orders of the day now. You have to show fast growth. Nobody likes slow, steady growth. So mergers, you have to be aware. ESG, financing, environmental, social, governance. How your business is contributing to the environment. For example, in Bangalore, they have one new cab service called as Blue Smart, BLUSMART, Blue Smart, who runs only on electric vehicles. And they promise 100% on no cancellation. Of course, you have to book a cab in advance. That's only disadvantage. But they are growing in size. Over time, it should also be available. Just like Uber, you should be able to book on demand. So they are focusing on environment. What they do is, every time you take a trip, you get a message telling you saved so much of carbon because you used electric vehicle. So like this, how your company is contributing to environmental, social or governance. Like in case of larger companies, are you transparent in reporting the good and bad things to the users of accounts? So governance, committees, what is being formed, what is your approach, policies, those kind of things are also CFOs now have to take a overview of it. So this is regarding advanced role of CFO in various matters. Then advanced capital budgeting, as I told you, that is a whole new chapter. You please read in my separate video. Security analysis, equity research and tools available. Okay. Equity research and tools available. Uh, there are so many applications, websites in there. Bloomberg is the earliest one. Even Reuters also will provide. in Indian context, see, for example, if you want to do a equity research, I want to know about the company's balance sheet, P&L, we need data, right? But even though we have various tools available, the purest form of data analysis, equity research analysis, goes by taking the data from annual reports. Various mutual funds, PMS that I have been associated with, which I've been interacting earlier, they follow good PMS firms. I'm telling, they follow traditional approach of going to the annual report and then taking the data from that. But there are some third party applications, like when fund manager want to invest in a new company, he don't want to go to the annual reports and take the data. He wants to make a quick decision. So at that point in time, he will use various tools available. Bloomberg, actually quite costly. I have used it. You get a separate terminal for Bloomberg. Terminal means separate system. You have to come to that system. It will not work any other cloud. Now I think they might have provided any online login. I'm not sure, but I was working on Bloomberg maybe 7-8 years back. At that point in time, in our office, there used to be separate terminal. So any equity research analyst who goes there and take the data, and Bloomberg has data of all over the world: Germany, Luxembourg, UK, France, Italy, Japan. What is their index values, what is their car production, what was their interest rates historically for last 50-100 years. Amazing Bloomberg. Now in India we have some more available, which not mentioned. I don't know where they have got it, but I will tell you what the tools which I have used. Capital Line is one of them. Ace Equity is another Indian data provider company. Pro42, who provide data on private companies, where I was part of. Even now I am to an extent on their artificial intelligence they are introducing, and I am also associated with some certain projects. So Pro42 provide the data on private companies. Ace Equity, then Capital Line. These are paid versions. You also have free versions. You can go to a website called as screener.in. I don't want to go into that extent now. In my regular equity analysis classes, I analyze those things. So go to screener.in, or even Google Finance has formulas equal to Google Finance, open the brackets, you the ticker, the symbol of the particular company, comma price, market cap, 52-week high, 52-week low, P ratio. Data available can be generated instantly even in Google Finance. So many tools are available where data is there. They have given the list. They have given this list, but I think whatever list I told you is different from this list. But you can also mention this: Stockpedia, Market XLS, Bloomberg, Benzing in, or whatever I mentioned, Screener, Google Finance. Those things are also can be used. Whatever I told you is more practical. Whatever they have told, they have taken from, basically these are paid versions. Okay, so this is the topic they've added: equity research and tools available. Next, security valuation, role and responsibilities of valuers. Role of valuers. So in various statutory elements, in various laws, you have to get a certificate on certain matters. For example, you say you are doing a buyback of shares. I was part of a company earlier. I was not a shareholder, I was a director there. So we have to do a buyback. We did some tax planning there, dividend versus buyback. That's a tax planning issue. I will not discuss that now, but we had to do a buyback. So for the purpose of buyback, we have to arrive at a value. So the value could be done by external valuer, or valuation could be done mutually across all the shareholders. Since it was a private company, we went ahead without any valuers separately, but if it was a listed company, then you need a valuation. If company is doing ESOP, employee stock price options, granting, vesting, exercising, you need a valuation. Mergers, and they have given the few lists like this. Where are the situations where the laws will require the valuer or a valuation certificate. In case of mergers, slump sale, that is IBC, when you do slump sale means selling entire group or a block of assets. IBC require conversion of debt or security in case of foreign investments. So RBI requires foreign currency convertible bonds, FCCBs. You are converting from debt to equity. At what value it is being converted? The valuation. RBI requires capital reduction, that is in case of ICDR again by SEBI guidelines. Strategic financial restructuring as per SURFACE, that is your securitization chapter. You are forming a special purpose vehicle where you are transferring all your assets and loans to separate purpose vehicle at a valuation. So those kind of valuation. Valuation is not only about equity, valuation is also about fixed income securities. And what are the responsibilities of valuers? This is the responsibility what a human should do in general, or for that matter any professional. We also have in FR, right, they have introduced ethics in financial reporting. What are the basic frameworks? Integrity, honesty, neutrality. I have discussed in the separate video. Please go and check it out. Ethics in financial reporting, a separate chapter in FR, applicable for new syllabus. A professional has to follow certain basic standards. He should be integral, he should be neutral. Integrity is the utmost virtue, I would say. Just for example, slightly out of the topic, somebody asks you, do you have any bad habits? Maybe in your marriage related interview, or maybe even in job interviews. Do you have any bad habits? Or somebody asks, is that person having any bad habits? Due diligence. Is that person having bad habits? Does he drink? No. Does he smoke? No. Does he go out with girls and does he gamble? No, not at all. Oh, very nice person then. Then what bad qualities does he have? Nothing else. He just lies. What? He just lie. So that is the foundation, right? If truth cannot be the basis, if truth is not there, then it can be lie about anything else, right? He can cover up any other mistakes possible. So integrity is the utmost virtue even a professional should follow, be it a chartered accountant or a lawyer or a doctor or a company secretary or a valuer, any professional for that matter. Integrity, you have to be conduct your business high standards, that is you are non-biased. You are always true to the words you use. You don't lie intentionally, of course, or you should be honest, straightforward. Be to the point. Don't be under the guidance that okay, that is the client who's giving you the business, so you have to give more value to him. Don't do that. Integral, fairness. So that's the list they have given. You can go through it. So integrity and fairness, I'll just focus on the heading point. Integrity means honest, straightforward. And fairness, take adequate data. Don't be too diplomatic. If you feel that company is not doing any particular business properly, ask that question. Company has come to you for valuation purpose. Ask them where your customers come from. Is the customer growing organically, or you are doing mergers acquisition and thereby getting more customers? Again, if I had to give Paytm example, when they were boarding new clients, they were giving it to the agents, and agents were not following the proper compliances and due diligence, thereby the customers were cheated. That was the main issue which RBI has found out. Anyway, let me not go to that extent. Professional competence and due care. Professional competence, you should do a study. If you are valuing company like, let's say, edutech companies, Unacademy, if you are valuing, be aware what happened to Byju's. What is good thing also happened to them, bad thing happening to them. So do enough research. What are the changes taking place in the current day context? Artificial intelligence is coming, chat GPT is coming, where you can create the characters, you can create the content digitally. Still, does this holds good? Or people prefer more of physical classes? Or anyway, free classes are available on YouTube, like you are watching this video on YouTube. So how the valuation is going to take place? To do enough research. So professional competence and due care, maintain professional knowledge, technical and professional standards, apply professional judgment, like you have to do discounting rate assumption, terminal value calculation, you know, right? Valuation, FCFF, FCFE, free cash flow to firm, free cash flow to equity, estimation of capital expenditure, working capital increase, right? The sales growth assumption, then constant growth assumptions, those kind of things. Interpretation of valuation report, should not disclaim in liability, valuation should carry the duty with due care. They're using in different words, in simple words like that. Okay, independence and disclosure of interest. You should not be the beneficiary of that report. If you yourself having, let's say, 20% stake in the company and you are valuing that, that is like giving Bharat Ratna to myself. I am part of government head and I gave it to Bharat Ratna myself. It happened in the past. I don't want to name it. You go and do the Google search. There are various past prime ministers, I would say, who gave the Bharat Ratna to themselves, like Nityananda style. Me, talking to me, sitting in me, something like that. Anyway, so if I have a share in the company, I should not do valuation, or if my relatives have it, disclose the interest. It should be not objective oriented, it should be not biased, it should be neutral in nature. Should not take an assignment in any of his or his relatives are associated, if in that case they are not dependent, or if you have any remote interest, like your son is working in the company, something like that, if something is there which is not really prohibiting legally, but if you have any some sort of association or interest, either you should withdraw from the engagement, or if you decide to continue, at least disclose such interests. Valuer necessarily disclose possible sources and conflicts, should not deal with security of the subject of time to time when the must become aware of the possibility of association. Valuer should not indulge in mandate snatching. One technical word is there, mandate snatching. Please remember, my dear friends, these are the rules given by the Companies Act, registered valuation rules. You have an exam, right? If you want to become valuer, just become a CA is not sufficient. You have to write an exam, and for that exam there is a code of ethics or the laws applicable, rules applicable, in which they have listed out these things. So the mandatory snatching is what we are looking at, right? Mandate snatching or convenience valuation. So your fees should not be depending on valuation. It is not like a commission, right? It should not be whatever valuation, 1% is yours. Then you give more valuations only, no? So that you get more value, you get more commission. So it should not be object oriented. It should not be the convenience oriented, convenience valuation. So one small different example I give you. In a shooting academy, you know the shooting academy, right? There will be a target and you have to shoot. And something you hit, something you miss, it's fine. In one of the places we observed, everything was perfectly shot in between. A circle was there, exact in between, a bullet had gone in. 10 circles like that was there. And exact in between, the bullet had gone. So I was surprised. How is it possible that all the 10 shots exactly went in the middle of that hole or middle of that circle? How the shot was so perfect? I asked the shooter, how did you do it? He said, very simple, sir. You can also do it. How you can do? First you shoot, then you put the circle. First you shoot, then you put the circle. You understand, right? That's not the purpose of shooting. If you can shoot and then put the circle, then anybody can do it. So you have to arrive at a value after doing so many processes. Not the way that I want this value, you somehow come to this. Sometimes this discussion happens in income tax in with the clients, right? You ask the client, you don't tell the client how much tax he should pay. You ask the client, how much will you pay? Accordingly, we prepare the books of accounts, which is not proper. But I have heard some people do like this. You also might have heard, I'm not sure. So like this, a valuer should not do it. Sir, how much value you want? Or you are getting work acquired by Reliance. You want 1,200 per share? Okay, I'll give valuation certificate for that. Like this, the target oriented valuation should not happen. Okay, and maintain a confidentiality. You will be handling many clients. So when you're discussing with the one client, don't talk it to others about other clients. Confidentiality. Information management. Maintain records for the decision making. Lot of assumptions will be there. Calculation, Excel sheets will be there. Valuation means I can say Excel sheet, though there are many tools available, nothing best as compared to Excel sheets. And when you have so many Excel sheet, there is a possibility people might be lost if somebody wants to verify. So when you give a formula, give a sheet, give a structure to that, like valuation sheet. Then prior to that, there is a balance sheet, there is a P&L, there is cash flow statement, there is a FCFF valuation. For balance sheet, where we have taken the values from each and every places, you have explanation and linking that will make the report more reliable, and your work is also considered as more professional and more diligent. Should appear, cooperate, be available for inspection investigations. A valuer should provide information records as required by registration authority, respecting confidentiality information during the course of performing professional services. Sometimes I should tell you, I have prepared a lot of valuation reports. In my initial days, if my boss used to ask me, how did you get this? I'll be like, I only gave this formula. Sorry, I don't know. So then he said, it's not about what you come up with. It's always about how you do it. The process is more important. Maybe I think I remembered Krishna from Bhagavad Gita for that. You focus on the process, not on the result. Result will take care if the process is given due care and importance. Anyway, so when you prepare a valuation certificate or you're doing valuation assumptions, follow due process, maintain records, and it might be subjected to audit trails as well. Gifts and hospitality. Don't accept gifts or don't give gifts. Both of them is not recommended. Remuneration cost. It should be in a transparent manner. Don't charge exuberant fees. It should reflect a reasonable reflection of work. When it's a reasonable reflection of work, don't just say you took 3 hours, so you should charge only for 3 hours. Your regular hourly fees is 5,000 into 3, 15,000. You should not charge like that, because to come up with the valuation, you would have spent good amount of money acquiring the knowledge. Be reasonable, be fair. Should not accept any fees which are disclosed to and approved by person. Fixing remuneration, that is basically gifts in any non-cash form. Like they will tell you, we'll send you for holidays, we'll give you some gold. So other gifts, other related remuneration should not be accepted. Occupations, employability restriction. Valuer should refrain from accepting too many assignments. If he is unlikely to be able to devote adequate time, you should do sufficient work. Don't do shoddy work. Valuer should not engage in employment, so don't join that company and then give the certification for that company. On those lines, you can go through this. So many points are there. Important points I can remember quickly is integrity, professional competence, due care, accepting gifts, and I would say be independent. Confidentiality. I would say the heading you remember, then you can write the points on that. That should be sufficient from exam point of view. Then we have precautions need to be taken by valuer before accepting any valuation assignment. Okay, So what are the precautions to be taken? In the context of valuation, I would definitely seriously recommend to go and search in the YouTube a person named Ashwath Damodaran. Many people would consider him as the authority on valuation. I enjoy listening to him. It's like watching a movie from me. It's so smooth. He gives you the actual data, unbiasedness, in simple one word, amazing and enriching your knowledge. So do follow. His name is Ashwath Damodaran, Indian, but very popular name in US. He settled in US for a longer period of time. He's a professor. He teaches valuation. His course is available in YouTube for free also. Whatever he teaches, he has given in YouTube for free, except you don't get certificate, but you get knowledge. So he says, a good valuation exercise is where two things are combined. One, quantitative, and second, qualitative. He says, to be a valuer, you need to have an aspect of marketing, an aspect of finance. Marketing means storytelling, convincing the other person. You speak to any salesperson, marketing people, they are amazing at convincing people. They somehow tell the stories in a way in which it is convincing to the other person. Sales people are amazing at manipulating others, convincing others, good storytellers. Whereas finance people are not good storytellers, but they are data people. They know what is the growth of the company, profitability of the company, debt equity ratio of the company, industry what rate is growing. They know the numbers. So their numbers are true. Numbers add good authenticity, but numbers are not convincing, you know. And when you tell only stories, the stories looks good, but they are not convincing. You understand, right? So if you want to be a valuer, you need to have combination of both. It's not just about preparing Excel sheets and giving the valuations. You have to go beyond that. If you assume growth rate of the company is 20%, tell a story. Story means what is the reason? Company is entering into electric business, electric vehicles business. Give a story behind it. For example, Blue Smart I was discussing, right? So I was listening to his interview. He said, what is the reason why we have joined this business even though Uber, Ola is already there? Because I see a problem. What is that problem? They suffer constant cancellations. And second, there is a surge pricing during peak time, like 9 o'clock, 10 o'clock, in the evening 6 o'clock, 7 o'clock. They charge something called as surge pricing, and they wanted to address that problem. And in that process, they also went ahead and one more problem which Uber or Ola and all they do is they are not company owned vehicles, right? They are individual driver owned. So the maintenance and all is no responsibility. Uber don't take responsibility. It is about that person. Nowadays the problem is always about taking responsibility. So this Blue Smart promoter was telling, I wanted to address these matters, and therefore I can see there is a demand for booking in advance, demand for people who want to use electric vehicles, demand for people who use a car in a good condition. For example, I was part of a client relationship management firm. So if we have to carry clients, we wanted that car to be maintained in a certain manner. It not only reflects the cab service company, it is also a signature of our company. What kind of cab service you're providing, what kind of cab you are associating with. It gives image about our company. So we would like to maintain, follow higher standards. So, and there is a data to provide it. Historically, the average cancellation of Uber is so much. So if you take that into consideration, the transportation number of transportation business, industry so much. If 20% comes to our business, see, we get revenue like this. So you need a storyteller and we need a finance person. We need qualitative aspects as well as quantitative aspects. So that's what they said here. A good valuation does not provide a precise estimate or value. It should not be specific. Estimation cannot be specific. Correct? How can you say I exactly estimate? No, it is always going to be approximate. And valuation is much more than evaluating financial statements. As I told you, it is not just about your debit, credit, balance sheet, profitability. No, there is a reason behind everything that is happening. In fact, one of the fund manager which I have been interacting with, he says, for me, data is 10%, 90% is people running the business. The fund manager. He's not a valuer, of course, but I'm just giving his perspective. He says, I invested in ITC not because of their product something. Their management have taken a decision to do diversification. They're not just going to focus on tobacco business, even though it is profitable. So they will be focusing also on FMCG products. I like their approach. I invested. Of course, there has to be a number backing it up. But the point is, more and more, it is beyond financial statements because no longer financial statements is your edge. It's available in public domain in bulk. So it is beyond just financial statements. And more often than not, investors tend to focus on either numbers or the story without attempting to reach the middle ground. I just told you, right? There has to be a balance between qualitative and quantitative aspects. While it is true that robust intrinsic value calculation, financial statements, data, and error-free model makes investing more technical subject, in reality, emotions play a massive role. As I told you, assuming a growth rate, discounting rate, the capex decisions is more of a decision-making, subjective matter rather than just numerical assumptions. So you have to keep these points in mind. Precautions to be taken by valuer before accepting a valuation assignment. Okay, coming to the next one. So we have done with the security valuation, precautions to be taken. Yeah, that we have done with it now. Next is securitization and in that tokenization. So what is tokenization? Institute also say before we discuss the concept of tokenization, it is necessary to understand the concept of blockchain. So what is really this blockchain is very technical subject. So to be honest, my knowledge is also very limited, but whatever possible, I will try to portray that. So the example which Institute has given, I will only use it, that is Google Documents. So if you go to Google Documents, it's very easy to open as well. You can just say doc.new, it will open Google document like a Word document. You can use it, you can share it with others and they can share it with others, and you can also restrict, you can make read only things like that. But what happens in the background, every time a new things has been worked, in the back end, there will be a history of it. Who changed what? Who created the file? Who modified it? What was modified? To whom it is shared? The whole series of sharing events, modification events, updation events will be recorded in the background. Whereas in a Word document, right, it's not easy for you to track wholesale because it is a the physical server base, in the sense it will be in your system. You send a mail, then he will save it in his system. Whereas Google Doc is an online mode, cloud based. So the entire the trail can be tracked and the sequence of events and the whatever the type of events. Something like that is the blockchain technology, distributed ledger technology. So when you have something like even cryptocurrency, we have Bitcoin, all these are based on blockchain concept. Blockchain means a block is framed. Every time, you create a Google document, a block was formed. Then you modified, another block was formed. You shared it, another block was formed. Google Doc is not blockchain. Huh? It is just an analogy. It's just a comparison to make you understand better. Don't go and write Google document is blockchain. So every time an action was completed or action was taken, a separate token gets formed. By doing that, we can understand the trail of events. At the same time, we can also avoid anybody manipulating or modifying it, because anybody trying to do anything, a new block gets formed. That's why it is called as distributed ledger. Anybody, it is not accessed by one central people, it is accessed by common users. If I have been given the username password, I can go, I can log in, I can do a transaction. I cannot change the fundamental coding behind it. If I don't have a username password, I cannot even log in. But if I have, I can go, I can do a transaction. But every time you do any activity or transaction, a block gets formed. And that's so that the manipulation is not possible or any fraud is also not possible. All transactions are irreversible. One transactions happened, you can't undo it. Like in Tally, you pass an entry, I think Alt D or Control D, I think Alt D, delete. But in Zoho, in SAP, once you pass an entry, you can't delete. You can only pass a rectification entry. You can only reverse it. So every time you pass entry, you reverse, history gets created. Data gets saved. Somebody can follow the trail later. So that's a major concept of blockchain. And applications of blockchain, financial services, it can be used. Healthcare, for storing the health records of patients. Government, where all the orders or even the records, like your what do you say, real estate records, kata, A kata, B kata, something they say, records. Then vehicle records. We have seen instances where the sale deed is being duplicated, fabricated. Two people have the original document for the same property. Everything is physical. So people did it. Stamp paper scam, Telgi series also came. So those things can be avoided. Of course, government is yet to incorporate this at a high level, but this will really empower the people at large, because manipulation is not possible. So economic forecast, travel industry, many places the blockchain can be used. What are the risks associated with the blockchain? Yeah, the risk associated with the blockchain, organization need to consider risk with wider perspective, as different member of particular blockchain may have different risk appetite, tolerance, that may further lead to conflict when monitoring the controls. There may be questions about who is responsible for managing risk. If one party is in charge, how proper accountability is to be achieved in a blockchain. Every time a transaction happens, a record gets created, but it is not controlled by one person, right? That is an advantage as well as disadvantage. That's the conflict. That's the paradox. Because the people at large can have access, there is a data security issue. So the question is, who maintains that risk management? Who have the authority? No one single person has the authority. It is like in cricket match, you see Pakistan fielders catching, ball comes, I think Syed Ajmal or somebody, he does it, then he looks at the other person. Other person would be looking at him. In between, the ball would have fallen down. So the question is, who takes the responsibility? Because of its decentralized structure, the authority division, authority assignment is not very clear. Reliability of financial transaction depend on underlying technology, and if this underlying consensus mechanism has been trampled, it could render the financial information stored in ledger to inaccurate and reliable. The technology involved, the internet has to be working, or technology should be sufficiently be trained. That's also fraud possible, right? First of all, people like me and you is difficult to understand how this technically works. What about the other people who don't are a tech savvy people? So there is a fraud possible, and if they don't understand the technology of how to use it, how to log in, there can be issue over there. Those kind of things. Absence of any centralized authority to administer and for protocol amendments, who will make sure any changes will take place, who will update it, which is the latest version control become an issue. Humongous data involved, so where it will be stored, that also becoming an issue. Who takes the responsibility, who maintains the cost, how it will be distributed, things on those lines. So it is blockchain. What is tokenization? Tokenization is a process of converting tangible and intangible into blockchain tokens. So it is applicable, tokenization is even applicable for your UPI transaction, Paytm transaction, when we do online, right? Looking at the QR code and we transfer. Underlying technology will involve tokenization. And one more small thing I was told, not directly connected, but the concept is similar to tokenization, so you should be aware of it. See, let's say I build a app, mobile app, or any application which runs on certain process. If I open in your system, will that run? It depends on whether you have Windows, whether it's professional, home, like Excel, right? We depending on some formulas will not work in older versions. You have wrap columns, then filter, then sort. Those formulas are there in the latest version of Excel. So when somebody is building an application or a mobile app, they try to follow this tokenization approach. So what they do is, when somebody clicks on that app, that will not open in their mobile physical system, it gets open in the cloud, and the cloud, an artificial or imaginative processing system is open, which will have the necessary requirements to run that process. You understand, right? An application may not work in your local machine because of system configurations. So to open that system, the moment a person clicks, an artificial simulated environment is opened, and that application runs on that environment. And for that also, this concept of tokenization is used. It is very similar concept. I don't know to what extent you have understood. Don't worry, I have also not understood so much. Whatever little I know, I am trying to share with you. Okay, so tokenization and securitization. Securitization meaning, a company or the bank, essentially financial institutions, have an assets, a mortgage-backed loans, that they want to convert that loan into a security. So they form a special purpose vehicle where they transfer all the assets for a consideration, and that company sells or raises money from investors, and thereby the loan has been converted into a tradable security. Because it is being traded, concept of blockchain can be used, right? So tokenization of illiquid assets, attempt to convert illiquid assets into a liquid and tradable, hence to some extent it resembles the process of securitization. So basically, large portfolio of assets, you are dividing this into small securities, right? You understand securitization? Company has got a portfolio of loans that is transferred to a special purpose vehicle who issues securities to the investors. So essentially, the investors, what they invest in one security, marketable security, one security, like that many securities are there, and they represent whole portfolio of the financial institution, the loan amount. So the big loan amount is essentially divided into small tradable securities, and that's why they say that securitization and tokenizations are similar. It is helpful in liquidity because marketable securities, diversification, investor can invest in many investment opportunities, equity shares, fixed deposits, debt mutual funds, including the securitization. They can do it. Trading, they are tradable. I think trading and liquidity are very similar, but trading means you can also do speculation. You can buy and sell, thereby making the profitability. New opportunities, both provide opportunity for financial institutions and related agencies to earn income through collecting of fees. Okay, so essentially, if I had to summarize, tokenization is a concept of blockchain which converts the larger data into smaller tokens so that every transactions conducted, a new blocks created, so that it results in a recording of all the events and transactions. And tokenization and securitization is similar in the aspect both convert a larger data into smaller points called as blockchains or tokens, and it helps in various points, advantages what we discussed. So this is regarding tokenization and securitization. Okay, so we have completed securitization. The next one is gold in portfolio management, and that is to be part of alternative investment avenues. In alternative investment avenues, many are there. The addition to the syllabus is with respect to gold. So it is said that Indian women are natural fund managers because they invest in gold for different reason, but that happened to be one of the best investment class. So I have done some analysis on gold investing. So when I was part of a wealth management firm giving the advice to the clients, we had told you have to invest in equity, in fixed income security, and also in gold. Gold, you believe it or not, in the last 50 years, it gave me an average of around 10%. People believe not only gold, but also things like silver, copper or silver requires or has good earning investment potential capacity. Anyway, let's focus on gold, traditionally considered as a natural hedge against inflation. Why? Because when there is increase in the prices, gold value also will increase. You believe it or not, I've done like a 5-year reading for many 50 years almost. I did the analysis. The lowest return was annualized 3 to 4% per annum. It has gone up to even 18% per annum. You don't believe it. You don't require any analysis. You don't require any thought which gold to buy. Gold is gold. Not like stock, right? Which company, who is the fund manager, who is the company, what is the product, what is the profitability, debt equity ratio. If I sell, then where will I reinvest? Gold is in that way very simple. So gold is a important wealth management instrument, just like equity. Of course, I am a big fan of equity investments, but for portfolio diversification perspective, investment in gold in any form is also an important asset allocation strategy. It is a natural hedge against inflation and also against catastrophic events like wars. When I did the study, I observed whenever a war happened, war between the recent Russia-Ukraine war or any political economic crisis like 2008 global financial economic crisis, in all those years gold price increased substantially. So if I have an equity investment as well as gold investment, if equity value decreases because of these political matters, economic matters, gold value increases, thereby your portfolio will be more stable. So gold is an important equity asset allocation instrument. You can invest in various forms. You can invest, of course, the Indian housewife likes, I think men also I can say, wearing golden instruments, ornaments. Now they are not no more ornaments, they are investments. I was also told, one of my colleague, he was telling his family was giving him advice like this: always wear a gold chain, because in case you lost somewhere, you're in medical emergency, you can give that gold chain and you can convert it. In one movie I saw, in Kannada movie, where a person was met with an accident and hospital people were giving asking for money. He did not have money, he gave his whatever, some golden ornament, and then the things went on smoothly after that. So it can be really helpful in emergent situation. And one more thing, I think Sri Lanka example only. Sri Lanka, there was a crisis, right, economic crisis. So when the whole country collapsed, what will you do? Your real estate and all will not be valuable. You can go from one country to other country, you can carry gold. Of course, legal means there are restrictions, but still, even if you pay necessary tax, let's say, easy to transfer from one place to other place is gold. It's acceptable universally. Real estate has got a value in certain place. You can't transfer. Equity depends on which equity to invest. Gold, universally it's gold. It is gold. Anyway, you can invest in various forms such as gold bars like a biscuit format, sovereign gold bonds, an amazing option given by Government of India. Again, we had recommended our clients, many clients, to invest in SGB who don't have gold exposure, because sovereign gold bonds in the form of a bond you invest. So you give money, you can if you have demat account with Zora than that, you can do it. I also have done it. If I had time, I would have shown it, maybe some other time. So usually government will come like 3-4 months once. They announce the series. I think about a couple of days back also they have announced one series. So you log in to demat account and you buy or you apply, like an IPO you apply to sovereign gold bond series from the government. You give the money, the bonds will be shown in your demat account. Your maturity period is typically for a period of 8 years. And the price at which you buy will be equal to gold price, little bit high, of course. But you don't have to pay GST, there is no transaction charges, this direct investment will be there. And so 8-year holding period, if you hold it 8 year, after 8 year, whatever the gold value at that time that value will come to your account. And what is most important, the capital gain is exempt if you hold it for 8 years. And more importantly, SGB will give you 2.5% per annum annual coupon. Now they make it, I think, quarterly coupon, half yearly coupon, I think, I don't remember. But they'll pay you 2.5% coupon also. So you get the benefit of gold appreciation, you get the benefit of no capital gain, and you get the benefit of annual interest coupon, 2.5%. You have a gold, physical gold. You have ornament, you don't earn any income. SGB give you that benefit. Gold exchange traded funds are there, gold ETFs, just like you have Nifty Bs, liquid Bs, ETFs for buying the Nifty, ETFs for buying the liquid funds, ETF for buying various things. Zerodha also has come up with large mid ETF, which replicates, no, I think not ETF, Zerodha came with index funds, I'm sorry. So ETF means exchange traded fund, part of mutual funds discussion, you know it. They are traded on the exchange. They can be bought and sold. You can be used for trading purpose also. So gold ETF, they invest in gold bar. So you don't want to invest in physical gold because security is a problem, maintenance. What if somebody takes away? And you should go and buy, the transactional headache. You can do those transactions digitally, simply buying the gold ETF. E-gold, that is, it is also, it's offered in NSE, National Stock Exchange, sorry, National Spot Exchange Limited, where e-gold, online gold, digital gold also can be bought and sold. So just like gold ETF, e-gold units are backed by equivalent units of gold kept with custodian and have less storage cost compared to physical gold. These also can be traded. They are very similar to gold ETF, you can say. Okay, so that is the gold which is been added. I think distress securities and all would have been already added there. Okay, gold is what I think they have added in alternate investment avenues in portfolio management. So that is gold. Next would be mutual funds. Moving on to the next adjustment, next amendment, mutual funds. Mutual funds are often considered as less risky as compared to equity market, even though even in equity mutual funds, ultimately they also invest in equity stock market, and the risk of stock falling down and risk of mutual fund is still there. But why do we recommend mutual funds over the stock investment is because mutual funds investments are decided by mutual fund managers, and they are expected to be professionals, and since they are professionals, they have experience, they will do a better job of identification of opportunities, timing the market, and also diversification and understanding the company and so on. So while evaluating the mutual funds, what are the elements to be looked at? And often many people lack the basic understanding of mutual fund as well. One of my friend was speaking, next week one mutual fund is giving, the initial offer is coming, it's coming only at 10 rupees. Can I invest? It will grow? No. They are thinking the mutual fund initial offer is like IPO of the stock, which is completely wrong. I understand it's coming for the first time, but mutual fund essentially they invest in the stocks. Those stocks are not IPOs. So mutual fund IPO, or when the mutual fund comes for the first time, initial offer, you should not look at like a IPO. So evaluation of mutual funds requires certain things to be looked at. So what are those things? Mutual funds analysis. Let's take a look at it. Since I was part of a basket of mutual funds selection algorithm, I don't want to name the company. So a company which was formed about, I think 10 years back, 10, 11 years back, more than 11 years back, they came up, they were a mutual fund distributor. They came out telling mutual funds are presently cluttered in the market, investors are confused, and we will recommend 4 equity mutual funds based on our analysis, and you invest in that for long-term wealth generation purpose. And I was part of the team which did the research on how to select a mutual fund. The quantitative aspect I was part of. So we had run various Excel model after Excel model, iteration after iteration model, and we had come to conclusion of one particular model. Anyway, let me not go too much behind that. The essence I'm trying to tell you is the evaluation of stock, looking like sales growth, profitability, and evaluation of mutual funds are different. So what are the things to be looked at? What institute has told, I will throw some lights, and then what I feel things to be looked at in my personal experience, that also I share it with you. Risk adjusted returns, meaning when you look at the stock or mutual fund, don't go only by the return it generates. For example, last 3-4 years, the quant mutual fund happens to be number 1 mutual fund. So many people, many clients asked us, can I invest in quant mutual funds? Of course, they can go and invest. But when I did the deep dive, I looked at, it was observed, their majority of the returns came from, they had investment in Adani Group companies. And Adani Group companies, they increased. What happened in the last 5 years? You know the better. And due to which these quant mutual fund also has been growing well. So I thought, in my personal capacity, I thought that may not be a good idea, because how do you identify that opportunity again? Because of that one good decision, of investing there, they got the returns. Can they replicate the decision? So when you calculate the returns, also calculate the risk associated with it. You have learnt in capital budgeting, you can calculate standard deviation, or in portfolio management you learn how to calculate beta. So consider those ratios, or you also have Sharpe ratio, Trainer ratio, right? Jensen's alpha. So those kind of risk element also you bring in, and then you compare with the returns, adjust it, then evaluate. One of the method which I had adopted in evaluating the mutual funds which I was part of the team earlier is called as a strike rate, not your not your cricket match strike rate. The strike rate meaning we look at, let's say, monthly performance of the mutual fund returns compared with its respective benchmark. Maybe next one point also I can include benchmark returns. Every mutual fund is expected to mark itself or have a indicator of its benchmark, because benchmark is a level where the mutual fund can say, this is what I'm trying to beat, this is what my objective is to reflect or beat the create wealth by investing in the stocks similar to this benchmark. For example, if you invest in large cap companies, large cap mutual funds in India will usually have Nifty 50 or Nifty 100 or Sensex as the benchmark. If you come to mid cap, something called as Nifty mid cap is there, Sensex mid cap is there, that can be their benchmark, or it can be Nifty 200, or if it is small cap, it can be Nifty small cap, BSE small cap. So various indexes are there. Depending on the theme of your mutual fund, you have to select the benchmark. So I was telling about what exercise I had done. So monthly returns you calculate for the mutual fund, and monthly returns you calculate for the respective benchmark, and you see whether the mutual fund return has performed well than the benchmark return on a monthly basis. How much percentage does not matter, just a yes or no. If it is performed better, we give a score of 1, otherwise we give a score of 0, basically a count. So we calculate, let's say, last 5 years, 60 months, how many times this stock has performed better than benchmark. Let's say this stock is performed better than benchmark. Out of 60 times, it is 40 times. 40 out of 60, that is 2 by 3. 66.66% of the times, the mutual fund has beaten the benchmark. Like this, you can arrive at a benchmark into your analysis, and you can also compare the risk adjusted returns, so that you understand it's not just about how much return they have generated, it's about how consistently they are able to perform better than benchmark. So a good mutual fund which performs over and above the benchmark during all phases of the market, during different phases. I think that also will come to a point later. Comparison to peers. Maybe if I can go to a website. I'm going to a website called as Value Research Online. So you can see, right? I have searched for, let's say, I look for the mutual fund which I like the most, Parag Parik Flexi Cap Fund. And okay, it has given the returns. Benchmark is the BSE 500 TRI means total returns index. They will also give you peer returns. You can see, right? In the equity flexi cap category, what is the returns over time? Are you able to see that? Comparison against its peers. So when you're taking the returns of a large cap, you should not compare that with a small cap. Oh, quant small cap fund has done better, sir. Large cap, why should I invest, sir? They are supposed to meant to have different risk and return characteristics fundamentally. So those should not be compared. You get the point? So you should compare with its category. For example, Parak Parik Flexi Cap is in Flexi Cap category. So in the Flexi Cap category, last 1 month, this category has given 1.88 returns, whereas Parak Parik 4.44. Last 6 months, 19.34 here, 19.34 here, and the flexi cap has given 22% and 34% here, 41 here. See, it has done consistently better than the category average. Category average website like Value Research, many other intermediary websites are there who publish this data. Or you can also take the data. Various data providers are there. You do the research yourself. You calculate the average or median and you compute as compared to the median or compared to the category average, how the mutual fund have been performed consistently over a period of time. Okay, let's go back. Yes. So I was telling about comparison to peers. Comparison of return across different economics and market cycles. That's one point people look at. Oh, last 1 year it has given return. Today, forget about 1 year. Some people say, sir, this stock today increased by 20%. Good stock, sir. Shall I invest? One day it increased, you will invest. That's what these IPL performances have been. One performance amazing, they do well in one match and they are selected for the national team, and they struggle especially when they go to other countries pitches. Our great IPL people fail, or when it comes to big matches like World Cup, we fail. Anyway, that's a different thing altogether. So when you want to call somebody a good batsman, it's not sufficient he performs well in Indian dead pitches or in certain stadiums. He has to perform consistently not only in India, in different kind of pitches. Why do we say Sachin Tendulkar, Rahul Dravid, Ganguly or Sehwag or even Virat Kohli are great people, great batsmen, because they can play Indian pitches, they can play spinners, they can play fast bowlers, they can go to Australian pitch and play scores, centuries. They can go to Pakistan and they can play well. They can go to South African pitches and play well. Not our IPL Tiger paper heroes where they just perform in IPL. Of course, they play good platform, good opportunity to showcase, but that's not the end of it. For you to be fundamentally good, you have to perform well across different conditions, weather conditions, pitch conditions, different teams, and so on. Similarly, a mutual fund or a stock should perform well across different business cycles. 2015-16, there was Brexit, Indian context, demonetization, then GST happened, then Corona hit, 2008 Lehman Brothers crisis, that is subprime crisis, market crash, global economic crisis, 2008, 2000 dot-com bubble. So 2000 may not be there, many mutual funds may not be there, but still that some people also might prefer to look at which funds did well even during those cases. In fact, when we recommend to our clients, when I was part of my previous wealth management firm, we were recommending which mutual funds to invest. One of the factor which we used to we used to recommend PMS firms as well as mutual funds. So one of the factors which we used to look at is in 2008, how much this fund performed. Of course, throughout the market, stock fell, mutual funds also would have been fell. But during the 2008, who fell less? There's a great mathematics behind it. Protection of capital is the number one priority as told by Warren Buffett. Many people don't understand that point. So it's not about how much you grow when others are growing. It's about how much less you lose when others are losing. Mathematically, I don't want to get into it. That's a different discussion. So mutual funds that we used to recommend, like Parak FlexiCap, in the year 2008-9, when the market fell down, like I think 40-45%, this mutual fund I think fell down only about 25-30%. You may feel, oh, only 10% difference. That's the important characteristics of a fund manager. When stocks going up, all kind of stocks will go up, whether good, fundamentally strong or not. That is, there is a FOMO, fear of missing, FOMO effect. So fear of missing out. So everybody will invest, stock market will go up. So in the bull market, or when the market goes up, all the stocks will go up. Logically, you will really not know which stock will give you the highest returns. But when the market falls, the fundamentally strong stocks will fall less. That's for sure. Because as I told you, good batsmen, the characteristics will come out not in the good batches. Good pitches, everybody play well. In the bad pitches, the true test of character of a batsman will happen. Similarly, in case of market falling down, the true quality of the portfolio and the stocks will be seen. So a mutual fund which has performed well across different cycle, especially in my personal opinion, when the market fell down, like in 2011, the Greece crisis happened like that, when the market fell down, how much less the mutual fund has fallen is the criteria that I look at. That is what comparison written across different economic market cycle. Financial measures, expense ratio, you should be aware of this. From 2013-14 onwards, I think, or maybe 16-17, I don't know exact date, SEBI has created a rationalization, radical changes where they have forced the mutual funds to issue mutual funds under certain categories. Otherwise, every mutual fund were having so many schemes. Okay, that is one part. Similarly, SEBI has brought in the concept of two types of mutual funds. One is called as regular mutual funds, other is called as direct mutual funds. Regular mutual funds means you invest in the mutual fund scheme through a distributor. Distributor is like a salesman, like a LIC agent, right? Distributor is the person who's promoting the product, and he charges his commission also, because he is giving the business to the mutual fund, so they have to pay him the commission, which is a percentage of the amount of investment, and therefore that route is called as regular route. That was there for ages, still there. But if you choose to invest in the mutual fund directly without the help of the distributor, without the help of advisor, directly you invest, there the mutual funds will not have the commission expenses, right? That benefit should be given to the mutual fund holder. That is called as direct, and NAV, the price also will be less, and that you have to look at expense ratio. Expense ratio, why I explained so much, because if I look at direct mutual fund, expense ratio will be around 0.91%. There also SEBI has put a guidelines telling you cannot cross beyond certain percentage. Around, let's say 1% is direct and 2% is about indirect. Indirectly means that 1% effectively is given to the distributor. Then what is that 1% the mutual fund charges? They have to take care of their expenses. Mutual fund salary has to be paid, administration expense will be there, accounting charges will be there, rent expense will be there. They are a company, they have to survive, they will have expenses. Expense ratio, they will charge it. And depending on the category of mutual funds, this expense ratio also will change. For example, liquid mutual funds don't have much of equity analysis. They only invest in liquid funds. So their ratio cannot exceed more than, I think, 0.25% maybe. They call it as 25 basis points. If it is an index mutual fund, it should not cross, I think, 10 basis points. I don't know the exact number, because index mutual fund don't have a fund manager cost. Their objective is to replicate the return of a underlying index. So they cannot have the charges like actively managed mutual funds that will have. So you should look at expense ratio, Sharpe ratio, trainer ratio, Sortino ratio. These ratios we would have discussed in portfolio management. You know about those factors. Coming to qualitative parameters. Qualitative parameters means what is the quality of the portfolio holdings. It's not just about how much return they have generated. What is the underlying stocks? Ultimately, equity mutual funds also invest in stock market only, right? Like if you ask me personally, if any mutual fund invest in IPO like Paytm, Policy Bazaar, Zomato, I don't invest in those companies because I personally don't like them. Not the Paytm or something. I don't believe in IPO market. That's my personal philosophy. Because I believe there is no requirement for you to take that risk of not knowing the background. IPO is coming for the first time. We don't know about the background of the company. They may do well, they may not do well. I'm not here to test. I'm not here to do trial and error. I'm here to save my wealth which I have earned in my job. So I invest in safe companies. First of all, equity market itself is risky. Why do you take additional risk unnecessarily? And especially, what is the definition of risk as given by Warren Buffett? Risk comes from not knowing something. It's not about uncertainty. Future nobody knows. But when I don't understand something, if I choose myself, I offer myself to the area where I don't understand, that's called as a risk. I invest in HDFC Bank. I know HDFC Bank does business like this. They charge money like this. They have a good, strong back record. I can see the management being strong. So I understand the business. So the new companies like Zomato never made profit. Paytm don't have revenue model. I don't understand, so I don't invest. Similarly, I don't want to invest in mutual funds who invest in IPOs like this. In my opinion, they are just raiding on the money of public money, SIP. The distributors are there. They simply recommend the mutual funds which give them higher commission, and then the public anyway gets invested. They were there. So I don't want to invest in that. So like that, I look at the companies, the mutual fund holding. Or you believe, I don't want to take mutual fund where they have banking exposure. India is a growing economy. I think it will grow well if the mutual fund invests in manufacturing companies more. If you feel so, of course, you can't tell mutual fund manager buy the manufacturing company stocks. That is his decision. He is independent. But what you can do, look at the mutual fund holdings where the focus is more on manufacturing. That type of mutual funds you can invest. Okay, so like that, you believe that according to you which stock is good or bad by looking at the stock holdings, and as per the rules, everybody has to declare the stock holdings. Just to give an example, maybe let's take up a practical example. So if you go to let me select I think quant mutual fund is what I gave an example, right? So let me search for that. Quant, let's say quant flexi cap fund. What is this portfolio will look like? They have invested, you can see, right? Maybe very small font, but I think you can see Reliance 9%, Adani Power, Housing Development, Urban Development, Geo Financial Services, Britannia, National Aluminium, Hindalco, Life Insurance Corporation, LIC. I hate that company. Steel Authority, Sun Pharmaceuticals, RBL Bank, Lupin, Punjab National Bank. I hate it again. Nirav Modi case. Okay, that might do well. I'm not denying it. The Adani Green Energy. Let me look at the Parik Flexi Cap Fund. What is that portfolio will comprise of? HDFC Bank, Bajaj Holdings, Power Grid, HCL, Coal India, Maruti, KCC Bank, ITC, Axis Bank, Microsoft US, Google, Meta, that is Facebook. They have international exposure also. Amazon, Kotak Mahindra Bank, NMDC. Okay, then 1 percentage investments. So you see, in my personal philosophy, my personal idea matches with this portfolio. So I go with this portfolio. Does not mean you should go. That's my personal opinion. I'm sharing based on my experience, my interaction. I don't want to get exotic returns, because if I go for exotic returns, I should be ready for losing. For me, stock market is not a trading platform. For me, stock market is a wealth creation platform in the long term, and therefore I am ready to invest only in fundamentally good companies. This mutual fund seems to have those, so I go with that. That's my personal choice. Just give an example how, looking at the portfolio holdings, you can take a call. Quality of the portfolio, track record, competence of fund manager. Ultimately, the stock mutual fund performs depends on the decisions taken by the fund managers, when to buy, when to sell. So go and take a look at the track record of fund manager. You feel Parag Parikh FlexiCap is doing well. Who is the fund manager? Rajiv Thakkar. For how many years he has been there? Since inception of the fund, he has been the fund manager. The late Mr. Parag Parikh, the founder of this fund, he was the initial pioneer who has so many videos in behavioral finance. If you have time, please go through YouTube. Very amazing lectures. Unfortunately, he died in a car accident. I think Rajiv Thakkar was also there. I don't know, not exactly. I'm not sure. Anyway, so he was trained by him, and he is there from the beginning. That shows, in my opinion, true character, the longevity of that person. That can be negative. Some people might say that it is like government office, so one person continued forever. That's other point of view. But I looked at his past performance. He's been a consistent fund manager, so the performance is attributable to his decision. And if I look at his background, I think he's also CA, I think so, or CFA for sure. I am convinced. If I look at some other mutual fund, every 3 years, the fund manager would have changed. So when fund manager has changed, new fund manager is there, how can you say he will bring him the same returns? Maybe good, maybe bad, we don't know. So go and look at the background of fund manager, credibility of the fund house team. That is what is the management that is going to decide. Again, this I was not told very clearly, but some people told me approximately, but anyway, just take it as an example. I don't know whether it's true or not. I have not done enough research on that. So in 2018-17, right, this ILFS crisis happened. ILFS crisis happened, that is housing finance crisis happened in India. The many bonds defaulted. Many companies defaulted. ILFS credit funds, ILFS debt funds, and many Aditya Birla debt funds, many companies which had exposure to those debt companies defaulted. So they passed on that losses to the investor. That is the difference between a debt mutual fund and a fixed deposit. See, debt mutual fund invest in fixed income securities. Fixed deposit also similar nature, but the risk is different. So when I give the money to bank and bank give the money to businessman, that's the chain of event, right? In case bank is not able to recover money, I am not going to be responsible as a fixed deposit holder. The loss is absorbed by bank. Whereas in debt mutual funds, like liquid mutual funds, credit risk mutual fund, long duration mutual fund, when I give the money to mutual funds gives the money to the same business house, but if those companies default, that risk is not absorbed by mutual funds, that risk is absorbed by investors. That's why I personally don't recommend debt mutual funds, because it's risky. If you are ready to take risk, take it in equity, or you take it in fixed income securities, which are supposed to protect your capital and not supposed to generate higher returns. So whereas I think HDFC and Aditya Birla, Those two mutual funds said, we will absorb the losses. I'm not sure about this. Take it as a hypothetical example. Two mutual funds said, we will absorb the losses. We will not pass it on to the investors. And that's also a concept of segregated portfolio. When this loss happens, that loss where recovery is not happening, that one is separated. That's called as segregated portfolio. I think one question was asked in the examination some year back. Anyway, so though two mutual funds houses said, we will absorb the losses, that show the credibility of the fund house. Anyway, so what track record they have? Like recently, there's also a problem of Axis mutual funds, I think, where there has been issue. Fund managers has to be fired because they have invested in some companies which is having some fraud or some scams. So Axis fund, some people believe it's not a trustworthy firm. So like that is credibility of the fund house to be looked at. Role of fund managers, as I told you, every fund, especially actively managed funds like Parak Parekh example, SBI Blue Chip funds, Axis Focused Fund, all these actively managed mutual funds, the decisions are taken by a person called as the fund manager. For a passively managed funds like index mutual fund, their objective is to replicate the return of an index. They will not have any fund manager as such. So what is the role of a fund manager? He should look at compliances, guidelines issued by SEBI, AMFI, reporting to the SEBI periodically. Investors are required dates and rules. So again in Parak Parekh, one of the interviewers said, a fund manager will have three bosses. One, the customers, investors. Second, the distributor who bring in. And third, the shareholders or the investors, promoters of the mutual fund. So he should you should keep in mind all the people's interest while making investment decisions. Monitoring the performance of the fund, which stock to buy, when to buy, analyze the company, look at his historical background. Fund managers will have a discussion with the management. They visit the industry manufacturing facilities. They ask the questions. They have great access. And many companies are obliged by their questions because fund is flowing to their company. May not directly, but market value is definitely influenced. So take part in the management analysis, ask questions, creation of wealth and protection, control over the works outsourced to third parties. Like any other manager of a company, that what he would do, those points should be looked at. Role of FIIs in mutual funds. FIIs, foreign institutional investors. In fact, in India, the word FI have been replaced now. People don't use the word FII, but in media, some people still use it legally. Now this is called as FPI, foreign portfolio investors. So what is their role? Nothing. Their role is very simple. If they believe that Indian market is going to give the profit, they will invest. Otherwise, they will take it out. I don't know what is this all about. FIs are important source of capital in an economy. Okay, they are important source of capital. It enhances corporate governance. These are byproducts. That is not the intention of the FIIs. Understand? The intention of the FII is very simple, to make money. If you believe India is doing well, they'll invest in India. Some problem with India, political instability, take out money, they put in China. They take it out, put out in Brazil. They invest in India's emerging market, or they take out the money and put it back to US. They don't care. They are not having any patriotism. Where they can make money, they will invest. But as a result of they coming in, there are some byproducts which Indian market will have the benefit, which is what we are trying to tell. If the foreign inflow happens to that company, the corporate governance, seriousness of the management will be there. Improved competition, because if somebody is investing in that, FI is investing in that company, not my company, why I'm not doing well, I'll also do well. So competition will be there. Improved inflow to the economy, foreign reserves will be there. So those are the role of mutual funds, role of FIIs in mutual funds. So this is discussion relating to mutual funds amendment as per the study material. Okay, the next we have to go to derivatives. Okay, so moving on to the derivative element, few things have been added, quite a few things, credit derivatives, real options and things like that. First one is exotic options. First of all, options itself is exotic. Now, then they are introducing concept of exotic options. I really pity our students. I really feel bad for you. To understand about the options, call option, put option, you try to put so much of efforts, and now they tell exotic options. They're adding next layer of complexity. Fortunately, we don't have any numericals on this. It's only a theoretical aspect. What is an exotic option? As the name suggests, exotic means something more complicated. For example, we have learned certain strategies, right? Strangle, straddle, like that. Now, that itself is sold as one option. How it will be? Now, what is straddle? I take a position in a call option as well as put option. If I buy both, I become long straddle. If I sell both, it becomes short straddle. Or if I keep a different strike price, it is called as strangle. Then we have bull call spread, bear call spread, bull put spread, bear put spread, butterfly spread, and so on. So many strategies were there. If that one strategy itself is sold, one basket of option is sold, that becomes exotic option. So exotic option has lot more layers than the plain vanilla, that is basic option. And in basic option, you will always have one strike price. Imagine if there are two strike price. And in basic option, it will be either call option or a put option, right? One of them will be there. But imagine you pay a premium, you become an option holder, but after some time, you can decide whether you want to be a call option holder or a put option holder. Something crazy, right? You decide the nature after some time, not at the inception of the contract. Sir, how to do valuations? Those things are all definitely much more complicated. Everywhere, of course, probability would come into picture. So those exotic features are there. Then they are called as exotic options. So exotic options are the classes of options with the structure and the feature different from plain vanilla options. So exotic option vary in terms of payoff and in terms of exercise. So they are different from regular position of a call option holder writer or a put option holder writer. This will be different. These options are more complex than vanilla options. That's why I told you so many features will be there. And they are mostly traded in OTC, that over the counter, in the sense they are not traded in a stock exchange. They are only mostly written between two parties, because it is option itself is so much difficult to understand, and many people are being misled in the market, money being lost. Though it is not really traded in the stock market, it is a contract between two parties, over the counter contract. That is what is happening with respect to exotic option. In my life, let me be honest, I have not seen any of that sort. Only theory in books only I have seen. I have not interacted with any company or with the corporation who have done. That's practically, I am being honest here. Types of exotic option. Some elements are there, depends on the feature. Chooser option. This option provides the right of the buyer after a specific period to decide whether it is call or put. Initially, you pay a premium, you become a writer. It will not be call or put. After some period of time, maybe let's say after 3 months or 6 months, then the holder can decide, okay, now I choose to make it as call option. Compound option, also called as split fee option and option. As the name suggests, this option provides us the right or the choice, not an obligation, to buy another option at a specific option price. This is to the next level. What is call option? Call option is right to buy the underlying security at strike price on expiry date. Please listen to this lecture only if you know the basics of options. Otherwise, this will be over the roof, over the cloud, over everything else. Normally, a call option holder will get a right to buy the underlying securities at a certain price, strike price on expiry date. He has the right, he is the holder. But now it's not the right to buy the underlying security, right to buy the another option. Call option having the underlying security as put option or a call option, right to buy another option at a certain price. Crazy. Anyway, that's option, that's called as compound option. Barrier option, though it is similar to plain vanilla, but unique feature is that it become activated only if the price reaches a certain price. Only if the price reaches certain price. Normal call option, for example, strike price is 100, you pay a premium of let's say 5 rupees, and you make profit if the market price goes beyond 105, but you will exercise the moment market price crosses strike price of 100. When the market price is more, call option is exercised. But the condition says, for example, option is exercised only if, or option can be exercised only if market price exceed 120 rupees. Sorry, but 100 rupees, that is your regular plain vanilla option. Barrier option puts a condition. For example, I am telling this option can be exercised only if the market price exceeds 120 rupees. Until then, you cannot exercise, you lose. Your regular formula, right? Payoff is equal to strike price plus premium, strike price minus premium. Those things don't work here. That's why I told you exotic option vary in terms of payoff and in terms of exercise. That's called as a barrier option. Binary option, known as digital option, guarantees the payoff based on happening of specific event. Like you bet, like betting, you say this election BJP will win, or this election BJP will lose. What is the effect on the market price does not matter. It is on a binary event. If this happens, you pay the premium. The payoff will be paid. Shares will be purchased. If not, you will not purchase it. Again, payoff patterns and all will be different. Asian option, these options whose payoff determined by average of the price underlying. We usually take the last price, right? Market price, close price. Here you take, let's say 6 months, you don't take the last price, you take the average price. That's Asian option. Bermuda option, Bermuda triangle, like that, Bermuda option. Bermuda option, it is somewhat compromise of European, American. European means it is exercised only at the end. American means it can be exercised anytime during the year, during the period of contract, you know that. Contrary to American, where it can be exercised at any point, the exercise of option is restricted to certain dates or expiration. So American means any time, right? Now here it's not any time. Let's say 10th of January, 20th of January, or 1st of February, 7th of February, you define the dates like this. Or at the end, that becomes European. A combination of both. That's called as Bermuda option. A basket option, like an example I told you, right? It's not, if you choose to sell a straddle as one basket, many options, option, writing, holding, same strike price, different strike price, a basket of option, that is called as basket options. Spread options depend on difference between two prices of underlying. So if you take between two different strike prices, a spread is created, spread option. Look back option, unlike other type of option whose exercise price are pre-decided, in this option, On maturity date, the holder of the option is given a choice to choose the most favorable strike price. Forget about strike price being fixed. In look back option, the strike price also can be chosen by the holder. Of course, premium will be different amount altogether. Anyway, so these are the elements that is related to exotic options. Okay, so now we'll go to credit derivatives. Now, credit derivatives, to understand this, you need to understand more about the securitization chapter. Make sure you understand the concept of securitization before you come to the credit derivatives. Essentially, what risk the lender will usually carry. The lender, if you think from a bank has given loan, what risk the bank will face. They said there are two risks. One is market risk, other is credit risk. Credit risk means the borrower may not make the payment on time. Default risk. He might default. That's called as credit risk. Market risk means interest rates being changed. For example, you have given the loan at a fixed rate of 12%, but the market rate is 13%. You are not able to make use of that higher rate. But if you are borrowing or if you are taking deposits, you will be paying higher rate. So market rate fluctuations is the interest rate risk. So financial derivatives can be used to hedge the market risk. Credit derivatives emerge due to hedge the credit risk. I mean, you can use the market related instruments for managing the interest rate risk, market risk, but credit derivatives, credit risk are required, right? The default risk, how do you manage? For that, credit derivatives have come, and there are two types. One is called as collateralized debt obligation and the other is called as credit default swap, CDS or CDO, credit default swap and collateralized debt obligation. Credit global swaps also there. Okay. I'll give brief introduction, then you can go through it individually one by one again. In fact, what happened in 2008 global economic crisis is a result of this credit default swap. Michael Burry, I think, who have taken a bet against the housing market, made tons of money, and recently also he made a statement that market will fall. It did not happen. Anyway, so that speculation is always there. So to understand about this credit default swap or this credit debt obligation, you need to understand the securitization aspect. So quickly, if I have to give a revision or the recap of what that would be, that is securitization process. Securitization. Let's say there is a lender and of course there is a borrower. And lender has given the money. So lender has a loan book or he has receivables or loans, portfolio of loans, which they want to convert that into cash. This lender want to sell this to somebody else. So a new entity is formed that's called as special purpose vehicle, SPV. A new company will be formed and they will issue securities to various investors, fixed income securities such as investor, let me be when it may be financial institutions, it may be pension funds, life insurance companies, or any large funds, mutual funds, and so on. So they give the money to the special purpose vehicle and they will give the money to the lender and they will purchase the loan book, portfolio book. And when the money comes in, when the money comes in from the borrower to the lender, and that will be passed on, paid through certificates, passed through certificates, right, given to the investors. Of course, it will be adjusted for whatever the interest rates at that point in time. Of course, investors are taking higher risk and therefore they will have higher returns as well. So with this mechanism, the lender have converted the illiquid asset portfolio of loan into marketable securities. These securities are marketable. These securities, right? I told you these securities are marketable in the stock exchanges. So other institutions can keep buying and selling. That's a continuously traded instrument. So you have converted the loan book into a marketable security. That's why it is called as securitization. And mostly this loan is housing loan, because most of the loans given by the banks are also housing loan, the two for a longer period of time, like 20 years, 15 years. And that's why this is called as mortgage backed securities. MBS, market backed securities. If it is any other type of asset which is sold like that, receivables will be there, bill receivable will be there, or any other type of loan, car loan, agriculture loan, if any other type of loan is sold like this, that is called as asset backed securities. This is mortgage backed security. If it is anything apart from housing loan, that is called as asset backed securities. Okay. Now this is securitization process which you need to keep it in mind to understand about the collateralized debt obligations. First one, while in securitization the securities issued by SPV are backed by loans and receivables, the CDOs, collateralized debt obligations, are backed by pool of bonds, asset backed securities, REIT, real estate investment trust, and any other collateralized obligations. That's an interesting one, right? You understood this point? While in securitization, what I just explained to you now, in securitization, what is being transferred, a pool of asset being transferred, is housing loan, mortgage backed securities. That is securitization. Collateralized debt obligation means apart from housing loan, if it is anything else like bonds, investment in bonds, real estate investment trust, any other CDOs. If you are investing in other CDOs, based on the CDO, you can make one more CDO. Like one wrapper, put one more wrapper, you say that is CDO. On that put one more wrapper and that is CDO. In fact, that is what has caused the problem in 2008. A movie was also made called as The Big Short. I'm going to play some snippets from that movie as well. Let me cover a few more points. So the type of CDOs, cash flow, collateralized debt obligations. Cash flow means you sell, like securitization process I told you, right? You have a bond or a portfolio of bond, you transfer it and you get the money. You get the cash. That is cash flow collateralized debt obligations. Synthetic collateralized debt obligation means it is similar to cash flow, but difference is instead of transferring the ownership of SPV, synthetic CDOs are structured in a manner credit risk is transferred by the originator without the actual assets. This is the important point. Credit risk is transferred by the originator without the actual transfer of assets. Basically means you have sold, but you have not sold. What is in the securitized process? I told you, bank or a financial institution has loan receivables which they are transferring to the SPV, and from SPV they get the money. But here you are not transferring the asset, but you are transferring the credit risk. Means what? The SPV is taking responsibility of default. You understand, right? The bank, the financial institution is not selling the receivables. I will collect the money. You don't collect the money. But if things goes wrong, you pay me the balance. You take the default risk. You become like a guarantor. Of course, I'm going to pay a premium for that. And that is what it's actually called as credit default swap. So basically, SPV buys the credit default swap, and the banker the banker is buying the credit default swap. Essentially, the risk is transferred from the banker, from the institution to the SPV. In previously also same thing happening, where cash is received, asset is yours, you take, you collect, your headache. Here, I am not transferring the asset, but I am telling, in case something goes wrong, please take care of the default, I'll pay you premium. So the banker becomes the buyer of credit default swap, and SPV becomes the seller of credit default swap. You got the point? The asset is not transferred, but risk is transferred, and that is called as synthetic collateral debt obligation. Some types are there, you can go to it. Arbitrage CDOs. Arbitrage meaning, between the two markets, there is a price differential. To take the advantage, an instrument is issued called as collateralized debt obligation. Basically, arbitrage, the issuer capture the spread between the return collateralized underlying CDO and the cost of borrowing to purchase these collaterals. So, underlying CDO will have one interest rate. If somebody has to buy this they need a money, cost of funding, cost of capital, the difference between those interest rates, somebody try to take the advantage of it. Okay, what are the risks involved in CDOs? Are structured products. When the moment somebody says structured product, investors should be careful. Default risk, yes, if there is borrower defaults, then the prime suffers. These type of risk, equity junior tranche in the waterfall. But anyway, okay, let me read this, important. Also called as credit risk, eliminates from the default of underlying party to the instruments. The prime sufferers of these type of are equity or junior tranche in the waterfall. Means, I don't know whether you understand that English. In the SPV ownership, no. Now, borrower defaulted or borrower paid little money. The question is, who gets the money first? Who get the right? Because in special purpose vehicle, various kinds of investors are there. There are equity investors, there are lenders, various kind of instruments will be issued by SPV. You understand, right? This SPV issued to investor will not be one security. So many securities will be there. So the question there would be, who will face the risk? It will be by equity tranche in the waterfall. First you pay to the fixed income securities, then you pay to second tranche. Ultimately, the general equity investors, they will suffer loss. The junior most tranche. Interest rate risk, yes, if interest rate changes and if the loan contract has a fixed rate of interest, then that is subject to changes. Liquidity risk on the date of settlement, like it's an instrument traded in the market. You want to buy, somebody else is not there to sell, or you are to sell, somebody is there not to buy. Same problem I can see with real estate also. Why? When as part of wealth management firm, we used to tell our clients, don't invest in too much of real estate, especially when you cross certain age like 55, 60 years. Because now you buy, later you need money, urgently, emergency purpose, you are not able to sell the real estate money. You cannot convert into cash, liquidity would be a problem. Same thing, if you are having CDO, there has to be a corresponding seller. If you are, buyer, if you want to sell, somebody has to buy. If you are not able to find, liquidity problem is there. Prepayment risk, the interest might be paid, the loan might be paid in advance. Reinvestment risk, so once you get the money from the borrowers, you have to reinvest elsewhere, generate returns. And if it is involving foreign loans, then foreign exchange risk is also there. Okay, so that you understand about collateralized debt obligations and two types, that is on cash flow collateralized and synthetic. Cash flow means money comes in, synthetic means just a asset is transferred, but impact wise it is same. If asset is not transferred, credit risk is transferred. Okay, regarding credit default swap, shall I explain now and then we'll go to the thing, or you want to? Okay, let us watch the video first. Regarding the credit default swap, let us watch the video. Credit default swap. It's a snip from
swaps on mortgage bonds.
2008 crisis, the big short.
Pay off if the underlying
you can watch on YouTube also.
Bond fails.
You
Okay, let me replay from again. I'll explain the term also.
I want to buy swaps on mortgage bonds.
You understand what he's telling? I want to take a position, swaps on mortgage bonds.
Credit default swap that will pay off if the underlying bond fails.
So credit default swaps that will pay off if the underlying fails. Meaning if the housing loan market fails, then these people have to pay money, for which of course he will make the payment and he will buy the instrument. Christian Bale is the hero. Amazing actor, I must say, especially in Christopher Nolan movies. Okay, so when he is purchasing the credit default swaps by paying the money to the Goldman Sachs. So Goldman Sachs is the, if you say, like an option seller, and the hero here, Michael Burry or Christian Bale, he is the buyer. So to become buyer, you have to pay premium, and to become seller, you will receive, but you will take the risk of, if things going bad, you will have to face the loss. Okay, this is used purely for speculation purpose, but it can also be used for hedging purpose. Like if you think from a banker, like securitization process I explained to you, if the banker choose to transfer his risk, you remember I told you collateralized debt obligations, you have a loan, you have a credit risk, you want to transfer, you buy the credit default swap by paying a premium. You buy, thereby your risk is transferred. So if banks fail to collect the money from the borrower, banks need not worry, because it is the responsibility of the special purpose vehicle to make the payment, that is the credit default swap, synthetic CDO. But CDO can be underlying CDO, that is a different layer of complication. That scene is also there in the movie. I'll come to it. I hope you are getting the point, what you are trying to understand. If I have to give you explanation once more, if you think from a bank point of view, bank has a loan which you are worried there could be a default. To protect against the default, to take an insurance, I can say, you have purchased, bank has purchased credit default swap by paying premium, so that if there is a default, you don't have to worry, other person will compensate the bank, other person will compensate the lender. But in this scene, what is happening? Michael Burry don't have any underlying loan. He's simply coming and buying credit default swaps. Means he is doing speculation. If his estimation comes true, he will make tons of money. If not, whatever premium is paid is gone. Correct? Anyway, so that is the case. Let's read it further. I mean, let's watch the movie further, not read.
You want to bet against the housing market?
Yes.
Why? Those bonds only fail if millions of Americans don't pay their mortgages. That's never happened in history. If you'll excuse me, Dr. Burry, it seems like a foolish investment.
Based on prevailing sentiment.
You understood the sentence? You will make money if millions of the people fails to make the payment, repayment, EMI, let's see what does he reply.
The market, banks, and popular culture, yes, it's a foolish investment, but everyone's wrong.
Everyone is wrong.
Good one.
Strong statement.
This is Wall Street, Dr. Burry. If you offer us free money, we are going to take it.
My one concern is that
If you offer free money, we are going to take it. So please be aware, even in general, if some money comes to you without any reason, it will not come. It might be at a difficult situation later. Evaluate your risk properly. If a government is giving freebies, free, don't fall for it. You are going to suffer at a later point in time. Anyway,
when the bonds fail,
when the bonds fail,
I want to be certain of payment in case of solvency issues with your bank.
did you understand this one? He is very confident things will fall down, and when things fall down, the Goldman Sachs has to make the payment, and the payment is so huge, he is worried about solvency issues. What if Goldman Sachs goes for insolvency? So he wants some sort of guarantee for that. That's why we say, right, the risk of an option seller is unlimited. He can go bankrupt. We have discussed this in basics of derivatives. Option seller, risk is unlimited. He can go bankrupt. Fancy. Because of this finfluencers in YouTube, I see so many people getting into derivatives, especially because they think they get free money and they believe that they can get strategies in options, derivatives. I please request, don't enter into those derivatives. This is a prime example. The risk of a option seller is unlimited. You make money 10 times, you lose one, your entire life is gone. Please don't become a seller, at least without hedging. Anyway, this is, let's move forward on this.
I'm sorry, are you for real? You want to bet against the housing market and you're worried we won't pay you.
Yes, that's correct.
Unless the market crashes.
Housing is never going to crash because it's so solid right now. It doesn't make mortgages. Get a home to deal with payout structure.
Dr. Berry, we could work out a pay-as-we-go structure that would pay out if the bonds fail, but it would also apply to your payments if the value of the mortgage bond goes up. You'd have to pay us monthly premiums.
Is that acceptable, Dr. Burry?
Let's rewind.
Your payments if the value of the mortgage structure that would pay out if the bonds fail, but it would also apply to your payments if the value of the mortgage bond goes up.
If the value of the mortgage bonds goes up, meaning that everything happening smoothly and your risk is increasing, you have to pay more premium. Let me redo it once more.
You have to pay us monthly premium. Dr. Berry, we could work out a pay-as-we-go structure that would pay out if the bonds fail, but it would also apply to your payments if the value of the mortgage bond goes up. You'd have to pay us monthly premiums.
Is that acceptable, Dr. Burry?
Yes, yes. I have prospectuses on 6 mortgage-backed securities all onshore.
Majority of the mortgages. Which lender?
Dr. Berry, these should be fine.
Yeah, we're prepared to sell you $5 million in credit default swaps on these mortgage bonds.
So Goldman Sachs is the seller of credit default swaps. We are ready to sell you to receive premium, free money. Enjoy now, suffer later.
Can we make it 100 million?
Absolutely, we can make it 100 million.
We'll be in touch. Send some paperwork over.
So 100 million he's paid. Okay. That's why in general I always say, anyway, I think I'll go to different direction. Let me not go there. Let's go read this. Let's watch this further.
These cups, could I take one for my son?
Yes. I have two.
Shake your money maker like somebody about to pay you. Don't worry about them haters, keep your nose up in the air. You know I got it. If you wanna come get it, stand next to this money like they make good. Like took your mama.
Is there any way to do 200 million?
Might as well shake what your mama
Deutsche Bank
gave
now.
you.
Goldman Sachs now. Deutsche Bank.
Looking good in them jeans, I bet you look even my whole hood is to my left and they ain't giving a so feel free to get loose and get carried away.
We do different projects. We do gardening. We do.
The bonds, I'd like to...
It's not bad seeing yourself up there on the big screen. It's very cool.
And taking my jet and how everywhere you turn, I be making you if you can.
Have like lettuce, tomato, no onion.
You know I got it. If you wanna come get it, stand next to this money like hey, hey. Shake your money maker like somebody about to pay you.
There is one more video which I thought is interesting. Let's watch that also.
If you're a business owner, then animated explainer videos are the best way to capture attention.
Have you ever wondered about credit default swaps? Didn't think so, but we're going to talk about them anyway. Now, this little demonstration illustrates the concept of asset-backed credit default swaps, but it's not exact. I'm taking a little creative license here to make the point. So, here goes. A person buys a house. I know this is a barn, but again, creative license. So the homeowner gets a mortgage from the bank and uses it to buy the house. The homeowner pays the bank dutifully every month. Little principal, little interest, little principal, little interest. Now, the bank might start to get a little antsy because this homeowner's credit might not be so great. She might lose her job. She might stop paying on the loan at some point, and the bank wants to make sure they get their money. So here's where an insurance company or other large financial institution might step in and say, hey there, bank, how about if we sell you this credit default swap?
Are you understanding, my dear friends? The previous video I talked about was on speculation using CDS. And here the CDS is primarily used for hedging purpose. I explained, but I'm just redoing it once more through this video. Watch it.
If Susie homeowner defaults on her mortgage, we'll guarantee to pay it off ourselves. Well, that sounds great to the bank, so they make the deal. And now, when the homeowner makes her mortgage payment each month, the bank gives a little bit of the interest to the insurance company in payment for the credit default swap's guarantee. The bank's profit is a little bit lower, but that's okay because their risk is lower too. So, what could possibly go wrong here? Well, what if there were trillions of dollars in credit default swap arrangements covering all kinds of bonds and other debt? And what if just a few giant financial firms were on the hook for all that money? And what if they didn't have enough capital set aside to cover themselves if the economy fell apart? And then, what if the economy fell apart? Of course, that's exactly what happened in 2008. And of course, the American taxpayer stepped in with trillions in cash to keep those giant financial firms afloat. And what of our intrepid homeowner? Millions of them did lose their jobs, got foreclosed on, lost their homes, and got accused of being irresponsible for buying a big house and taking out a big loan. This is a problem that still has not been fixed. And on that cheerful note, thanks for watching. We'll see you next time.
Okay, great. So I hope you enjoyed these two videos on credit default swap and understood the concept of speculation and on hedging. Now let me also show you one video from Big Shot on collateralized debt obligation CDO and synthetic CDO. And along with that, whatever little I understand, I'll also share my thoughts. Let's go and play that.
Hi, how are you? Okay, Mr. Bennett, what do we have?
Let's see what you got.
You smell that? What is that?
What?
What's that smell?
A cologne?
No.
Opportunity.
No.
God,
money.
he smelled that opportunity. And he
I
says
smell
money.
money.
Yeah, that's amazing.
Chris.
Conversation.
Damn it. Sorry.
Watch this.
This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the US government. The modern ones are different. They're private, and they're made up of layers of tranches.
Please observe this word, layers or tranches. We have read this sentence earlier, right? When the default happens, the junior tranche will face the loss. The reason being, it is not just a AAA bond or a AA bond or a single A bond. It is not an independent bond. There will be combination of bonds. Collateralized debt obligations of collateralized debt obligations. If you take only one bond, it might be just a single rating. But if you take a portfolio of bonds, AAA also there, AA also there, single A also there. Many people have seen, when I interacted with the clients when I was part of wealth management firm earlier, they manage the stocks themselves. And they say, this stock I purchased became 5 times, multi-bagger. How much you invested? That not much. I invested only little. That is what is matter. Overall portfolio, what is the return? So here, when you're trying to understand about the instrument, don't look at one instrument. Oh, this is AAA. What is the overall instruments? What is the weighted average of those? Then you understand, because when money comes, which will default? The D will default, or the person which is junior most tranche will suffer the loss. Anyway, let's watch this further.
The highest level AAA is getting paid first. The lowest rated B is getting paid last, taking on defaults first. Now, obviously, if you're buying Bs, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these Bs and double Bs went from a little risky to dog shit. Where's the trash?
Behind you.
I'm talking rock bottom FICO scores. No income verification.
No income verification.
Adjustable rates, dog shit. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to 0 too. And that, you're too close, is an opportunity.
Okay, you're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
How come nobody's talking about this?
You're completely sure of the math.
Look at him. That's my quant.
You're what?
My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face.
That's pretty racist.
Look at his eyes. I'll give you a hint. His name's Yang. He won a national math competition in China. He doesn't even speak English. Yeah, I'm sure of the math.
Actually, my name's Jiang, and I do speak English. Jared likes to say I don't because he thinks it makes me seem more authentic. And I got second in that national math competition.
So you're offering us a chance to short this pile of blocks? How?
With something called a credit default swap. It's like insurance on the bond, and if it goes bust, you can make 10 to 1, even 20 to 1 return, and it's already slowly going bust.
10 to 1, 20 to 1? No way.
And no one's paying attention. No one is paying attention because the banks are too busy getting paid obscene fees to sell these bonds.
But wait, you are the bank. When you work for the bank, I bet your margins are pretty nice and fat.
Let's not talk about my margins, by the way. Being nice and fat, that's a nice shirt. Do they make it for men?
Aren't you the bank?
I work for the bank. I don't think like a bank. Big bank, small bank, I like to make money. All right? Let me put it this way. I'm standing in front of a burning house, and I'm offering you fire insurance on it. A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market.
Okay, fantastic. Okay, so now moving on. I hope you're able to understand and appreciate the impact of the credit default swaps. I think now I don't have to talk much about it. Let's quickly run through it. Credit default swap, credit, loan given, default, non-payment, swap, meaning the risk is being transferred, liability, exchange. Features is a non-standardized private contract between buyer and seller. You can see in the videos I've shared, it is not happening in a stock exchange. People are going and signing the contract, happening between the private parties. They are normally not traded, repetition of the same sentence. International Swap Derivative Association uses the formats, the guidelines given by some association, can be purchased from third party to protect against the default. Okay, some similar points are there, you can go through it. Use of default swap hedging, like when the banks when the bank buy in order to protect the risk, that is hedging. Arbitrage, when you're trying to make the advantage of the price differential between the two markets. Speculation, I think the less I say, the better it is. You have watched it yourself. Parties, initial borrower, like in this example I gave you, right? The initial borrower, like in the 2008 crisis, economic crisis, the people who borrowed money to buy the house. Buyer, basically in this case, the people, hero in the movies. Seller is the writer, Goldman Sachs, Deutsche Bank, those kind of things. Settlement, it may be physical settlement or it may be cash settlement. That is, the difference happens on settlement on net basis. Cash settlement differential happens on net basis, and that you know it in derivatives can be settled either on delivery basis or can be on cash, which is difference between the settlement price and market price. That is called as cash settlement. Anyway, those things should not be a problem for you to understand. Okay, so this is about credit derivatives. Hope you enjoyed this discussion. Let's move further. So the next topic in derivatives to be discussed is real options. Real options are again about a type of option. In options, there can be call option and put option. Call option means you have right to buy the underlying asset at a certain price. Put option means right to sell the underlying asset at a certain price. Real option means it is applicable in capital budgeting. Capital budgeting in construction problems or various projects, you are not sure whether it will be successful or not. For example, about drilling an oil or drilling beneath the earth to get certain metals maybe. You want to protect yourself against uncertainties. So what do? You take an insurance. So what do you say? If the project is successful, then I will continue. If not, I will transfer it to somebody else at a certain price. That is like a put option. Or if the project is successful, then I'll continue. Otherwise, I will not continue. Like a call option. So application of options in capital budgeting, and that is called as real options. Let's take a look at the theory points there. So real options is applicable in capital budgeting. Applicable in capital budgeting. So real option, how it is different from financial option? Underlying asset in financial option is about shares, financial instrument, whereas in real option is about projects. Payoff it is based on a certain price, strike price, whereas here in real option it will be based on cash flows, so it can be even variable. Exercise period, it's usually short term. Whereas for real options it is usually long term. Approach, this in financial option we call it as pricing of options. In real option, because of long term projects involved, it is called as valuation, but ultimately the process of calculation, the methodology will be same. So same four varieties: long call, long put, short call, short put, that is a call buyer, call seller, put option buyer, put option seller, that is holder and buyer. Similar four situation exist. The valuation, three models: binomial model, risk neutral model, Black-Scholes model, the same thing what we discussed in the other regular option valuation applicable here also. And then types of real options, we have growth options. Anyway, growth options applicable in areas such as research and development activities, where you are doing the research, you don't know the outcome, the uncertainty exists. To cover yourself against the uncertainties, you protect yourself by taking the option route. Any things like that. Problems are also there. You can go through it. I don't want to spend time. This being a theory discussion, problems you can go through it, but conceptually I can tell you it is same as any other regular option. To be specific, one more variety is called as abandonment option. Abandonment means you are doing a project. After 1 year, you want to have yourself a choice whether you want to continue the project or you want to discontinue the project. Of course, you transfer the risk to somebody else by paying a premium. After 1 year, if you feel it is advantageous, you continue the project. If not, at a predetermined price, strike price, you sell the projects to other party. That's called as abandonment, option to abandonment, option to sell. Nothing but a put option under regular circumstances. Anyway, so same thing is there. You can go through the problems. I don't want to spend time on the problems on real options. Conceptually, it is same as any other regular options. So real options are done. Next, coming to weather derivatives. As the name suggests, derivative, where underlying instrument is weather. See, in agricultural situations or various companies might be influenced, affected. For example, you talk about wind power companies, wind energy companies. What if there is a issue and there are no enough winds? You suffer losses, so you take a coverage against that. Those underlying instrument where it is a weather, these are not commonly available derivative. If you and me want to buy, we can't buy. These are all over the counter derivatives entered between two parties, like a contracts. But conceptually, weather derivative means where the underlying instrument is weather, like temperature. Let's quickly read through that if you have anything. Weather derivatives. There are many companies whose performance are unaffected by weather, but there are many companies whose performances are adversely affected by weather. For example, airline companies, due to problems, they are due to air control problems, due to rain issues, they may not be able to fly. There are if you take an example of Delhi airport, continuous issues, fog problem, rain issues, and there are delays. So airline industries have to keep those things in mind. And what you can do to cover yourself against the risk, you take the insurance. So it is over the counter contract. As I told you, you don't have any exchanges selling these derivatives. Pricing the derivative is quite challenging. So data is also challenging, because weather data, where do you get? Unlike a share price data, we have a history for long period of time. Anyway, forecasting of weather is also issue. Temperature modeling, identifying what could be the temperature, what circumstances, is a challenging issue. Anyway, that is relating to weather derivative. Electricity derivatives. As the name suggests, the underlying instrument is electricity. If you are supplying power to state government or any other organizations, and you want to protect yourself against the fluctuation in the power prices due to calamities, due to other power shortages, there can be instances where you have to pay more. For example, in Bangalore, due to water shortage, the water tankers prices are increasing significantly. Maybe as a Bangalorean, I can enter into one derivative where underlying instrument is water. Anyway, that is not yet come. It may come in the future. Electricity derivative means you are trying to protect or control the fluctuations in power prices by entering into future forward swap, any other contract. Electricity forwards, electricity futures, or electricity swap. Again, same concept of forward contract, future contract swap applicable in this case. So this is with respect to electricity derivatives. Now, as a last part of derivative chapter, we have something called as derivative mishaps and lessons. So there are certain situations in the past where by entering into derivative transaction without knowing its consequences, people have suffered huge losses. I'm afraid, looking at the way this social media is influencing, or we call this as fin influencers, selling their option derivative courses, I'm afraid even the common public now is falling for this. Derivative is supposed to be an hedging instrument, but now it is turning out to be a gambling instrument. Lot of speculation taking place. So there are some practical cases that have taken place in many other countries where people have lost in billions of dollars, even the famous banks and financial institutions. Certain instances are given here for your reference. Okay, so the first among them is Orange County case. This happened in California municipality. It's happened in a government department, not talking about private institutions. It happened in the year 1994. 1982 Harshit Mehta scam was happening in India, and 1994 happened here, California municipality. So basically what they did is, one of the person, the treasurer who had money with him, he gambled in derivatives. He used something called as yield curve play strategy. That means he took the arbitrage difference between the long term and short term rates by leveraging the position of the fund. So basically he borrowed the funds at a long term rate and he lent the funds at a short term rate, and thereby trying to get the difference between those interest rate a benefit. Like even you talk about in India, for example, FD rates. If you deposit for 1 year, you get 5%. If you deposit for 3 years, you get 6%, 7%, right? So by using this arbitrage, he borrowed at a short term and he lent at a long term, or vice versa. I don't know which one did he did exactly. But what really happened, he was enjoying that 3%, 3-4% above returns for a certain period of time. But when the cost of borrowing increased, because the lending was done for a longer period of time, the short-term loan rate increased, he could not pass it on to the investment. See, you borrow money and you have done the lending, you have deposited, you have lent it. Now lending is for a longer period of time, borrowing is shorter period of time. Now if the cost of borrowing increased, you can't do any changes here because loan is already given. So that's what happened here in this case, and there is also about loss about 20 billion loss something happened. That is a huge amount definitely at that point in time. So Federal Reserve suffered huge losses, and they have to produce 515 50 million in cash as a margin call to offset that increase in interest rates. So finally he was given a sentence of year, and he was fined so much of dollars. I don't know what impact that is going to do. Anyway, that was first case, Orange County case. So the next one is barring bank case. Anyway, the details are here. I got one good about 5-6 minutes clipping in YouTube. I'll play it for you. Hopefully you will also enjoy. Instead of me explaining using my voice, let me play that video. Later we can discuss together.
Story of Nick Leeson, a man who, despite his humble British working class roots, managed to achieve the pinnacle of the American dream, making a bunch of money doing fraud on stock exchanges and then single-handedly destroying the oldest bank in England. Specifically, Nick destroyed Barings Bank, named Barings after its founder Francis Baring, and bank after the word bank. Established in 1762, Barings was renowned as one of the oldest, bankiest banks around. In fact, it was once considered, quote, the sixth great European power after France, Russia, England, Prussia, and Austria, and like Prussia, it no longer exists thanks to a self-involved idiot with poor taste in hats. Our story begins in 1992. It was a big year for sleazy white dudes. Bill Clinton was elected president, the Red Hot Chili Peppers were topping the charts, and Nick Leeson was named general manager of the Barings Futures and Options Office on the Singapore International Monetary Exchange. Soon, Nick gained a reputation as a whiz kid on the foreign futures market, at one point being responsible for 10% of Barings' entire yearly profits. But it turns out that he was less a whiz kid in the sense that
1% transaction accounted for 10% of the bank profit. He must be a superstar. This is one thing I always tell the people in general, to students particularly with folded hands. If somebody comes and say, I can make exuberant profits, please don't blindly follow them. Try to understand what they're doing. Like in this case, this person made a huge profit, accounting for 10% of the largest bank's profit. If you talk about a HDFC bank, for example, they make about 50,000 crores and one person made 5,000 crores profit. You understand the magnitude of this? Don't just get enjoyed by one person making profit. Please understand what is the risk he is taking, which the bank failed to observe here, and they paid the price and they closed it. So basically he took lot of speculative position and he was making profit up to a point as long as his bet was going wrong, and then when he lost, let's watch the video further.
that he was smart, and more a whiz kid in the sense that he was whizzing money away. Barings' downfall started with a simple mistake. One of Nick's employees was supposed to sell some futures contracts for a client, but they accidentally bought the futures instead. It was a dumb mistake, but before you judge them too harshly, consider that you, the viewer, has no idea what selling.
Got it. This will happen. I did do a lot of trading. It can happen. Many people lost money, huge money. Instead of selling, they went and bought it. If you let the rookie, the fresher handle the business, these mistakes are common. So you should always have a stop loss, always have a place and checks in procedures.
A future even means. Anyways, the mistake meant the client lost £20,000. Nick needed to make the client whole, but he couldn't just add £20,000 to the client's account out of nowhere, so he created something called an error account connected to the bank's funds, which he debited £20,000 so he could credit the client's account £20,000. While error accounts are a somewhat common accounting practice, the problem here was that Nick didn't want anyone to know about the mistake. So he came up with a plan. Instead of following normal practice and telling his bosses about the error account, he was going to make unauthorized trades to try and earn the £20,000 loss back and then zero out the error account. It was a brilliant plan.
So you understood the sequence, right? There was an error due to which there was a £20,000 loss, which he did not want to disclose because if he showed, he would have been thrown out of the job. So he transferred to something called as error account. And before somebody else come to know, he wanted to make a profit and adjust towards it. he wanted to do that.
Except for the part where it failed spectacularly. Nick didn't make the money back, and then
Got it. Nick did not make the money back. Many people teach these option derivatives workshop 2 lakh per day. Oh my God, I don't know how do they charge and what about people who pay that? And they talk about adjustment strategies. If this goes wrong, then this adjustment, this call you adjust. I really don't know how many families are going to lose the breadwinner because of this mayhem happening around derivative strategies. I'm not in a position to stop all those things for sure. At least because of this case study being introduced, I hope you will not be one of them. Let's watch it further.
Then things got much, much worse as Nick began using the account, which he named account 88888, as 8 is supposedly a lucky number in East Asia, to hide his own increasingly bad and desperate trades. By the end of 1992, he had lost £2 million. By 1993, he'd lost £23 million. And by 1994, account 88888 was £208 million in the red. The tipping point came when Nick tried to make back his money by doing something called a short straddle. In order to understand short straddles, you have to understand two other financial instruments, a put and a call. And in order to illustrate, let's say that the asset we're dealing with is sandwiches, because I'm not allowed to go to lunch until I finish this script and that's all I can think about. A call, or a call option, is an agreement between a buyer and seller. The buyer pays the seller a certain amount of money, called a premium, and in exchange, the seller of the call option agrees that they will sell a sandwich to the buyer at a set price at a set time. What's interesting is that the buyer does not have to buy the sandwich, but if they choose to buy the sandwich, the seller must sell it to the buyer at the agreed upon price. So the buyer is hoping that the price of sandwiches will go up so that the buyer can sell it at the premium they were put at a down and put on the same asset at the same time. When you short straddle, you're hoping that sandwiches will stay at the exact same price.
Short straddle, you know, right? You sell call option, you sell put option. In call option also you're writer, unlimited risk. In put option also you're writer, unlimited risk.
That way, the buyers of both the put and the call won't have incentives to exercise their options, the seller isn't forced to buy or sell any sandwiches, and will make money on the premiums they were paid. The downside is that the short straddlers' losses are theoretically unlimited because the price of sandwiches could go up to an infinite amount or alternately go all the way to zero. Now, Nick Leeson did a short straddle of the Tokyo and Singapore markets, essentially betting that the markets wouldn't move. Because God has a great sense of dark comedic timing, the Kobe earthquake hit Japan the next day, killing 6,000 people, leaving 45,000 homeless, and worst of all, destroying.
This is called as black swan events. So we normally call this option sellers eat like a chicken and shit like a elephant. They make small profits, but one time when they lose, bankruptcy.
One badly dressed guy's market position thanks to the Asian markets tanking. In the end, he lost £827 million, or about
what was the original amount? £20,000, and now 827 million. To cover one loss, see how many things have been turned up. A life lessons also for you, my dear friends. If there is a mistake, please accept. Don't let the mistake compound. We say power of compounding. It is not only applicable for investments, but also applicable for things such as the losses or the errors. Let's watch it further.
$1.4 billion, more than twice Barings' total trading capital. Nick left a note that literally just read, "I'm sorry," and fled, eventually getting arrested in Germany, sent to Singapore to stand trial, and sentenced to 6.5 years in prison. But then Nick Leeson did what all great finance bros do. Failed upward. He got out of prison in 4 years on compassionate release because he was supposedly dying of colon cancer, but then he didn't die. Then he wrote a book that got turned into a movie starring Ewan McGregor, and then he competed on Celebrity Big Brother and Celebrity Apprentice Ireland. Barings, on the other hand, declared bankruptcy, got sold to ING for £1, and hasn't appeared on Celebrity Big Brother even once. Now, I know what you're thinking. I'd love to use accounting tricks to take down one of the oldest banks in the world, but my math skills are just too rusty, and every time I try to refresh them or learn new stuff, it's confusing and boring and frustrating. That's why Brilliant is here, to make
Okay, so that was the case 2, Baring Bank's case, who tried to cover up the error and ended up the banks getting closed. Anyway, that is Baring Bank. Then similarly, Procter Gamble Gibson Greetings case also there. Please do go and read about it. 2 cases I have read, 1 case you read it yourself. This also again relating to one of the persons taking the speculation and ultimately suffering losses. So lessons: don't buy derivative that you don't understand. Derivatives are primarily meant for hedging purposes. Unfortunately, these days it has become hugely popular for speculation and it is turning out to be gambling place. So due diligence before making Treasury Department a profit center. So when you have a short-term money, don't ask them to make good profit. Your business, the objective of the company is to make money through business, not through this Treasury Department, and from there you have to make money. Their money is there, you can do it for short-term purposes, but keep an eye on them, how they are making profits. Specify the risk limits. Separation of front, middle and back offices. So separate of the functions, people dealing with the clients, people managing the money, and people investing have the separate functions, especially in banks. This has to be carefully to be done. Ensure hedger should not become speculator, and carry out the test or scenario analysis, that is under various situations, how much risk you are likely to face, how much profit you are likely to make, have the scenario analysis being done. Even in our risk management chapter, we had done the concept of value at risk at 99% risk level, at 95% risk level. If you remember, those kind of things shall be done to understand about the risk limitations. So this is regarding the derivative chapter, the changes have taken place. Now moving on to foreign exchange risk management chapter. Very few topics have been added. Let's cover it quickly. First one is the role of SWIFT in foreign exchange. What is this SWIFT? Foreign exchange dealers carry out the transaction through SWIFT, that is called as Society for Worldwide Interbank Financial Telecommunication, which is purely a messaging system like a WhatsApp for banks, WhatsApp for financial institutions, just like that. Because there will be a lot of international transactions takes place, right? Money will go from India to US, US to UK, to Germany, to Hong Kong, to India, to foreign transactions. Somebody needs to keep a track of it. When I transfer dollars from my account to US account, physical US dollar will not be transferred. There has to be a information record on both sides, and that is being carried out using the SWIFT, like a software. It's a messaging system. So you are assigning the codes to each country, like US dollar, USD, for pound, GBP, code has been given. Based on the code and the software, people can interact, communicate how much amount have been transferred, remittance outside and remittance coming in. They uses the common language for financial transaction. It uses centralized data processing system. Like in India, locally we have something called as clearing house. That job is done by SWIFT internationally. It covers institution more than 200 countries. SWIFT plays an important role. In addition to validation of statement, quick settlement, okay, security, reliability, a backup system, recovery system, catalyst in bringing the financial agents to work in a faster manner. So SWIFT is basically a communication tool for the purpose of transaction between the institutions at an international level. That's all with respect to role of SWIFT in foreign exchange. Then we have national and international payment gateways. Payment gateways. Like in India, we have Paytm, that UPI transaction, payment gateway. We can just take a scanner and then transfer it instantly. I can't do for a US dollar, but I can do within rupees. But for international transfer also, that payment gateway has been configured for your Visa card, MasterCard, and encryption have been done. If you're transacting through computer, if you're transacting through mobile, the software behind it, that's called as payment gateways. Benefits are there: convenience, security, reliable data transactions are there, backup, recovery, facility for the customer to refund in case there is an issue happens. There can be reversal of transactions. So those kind of things are there. Again, nothing much to discuss about this point also. Payment gateways. Then Forex, coming to popular derivative products. Popular derivative products, you are already knowing it because it's popular. In the sense, what are the products that will come in the foreign exchange risk management chapter? Importer will go for forward buy for hedging purpose. An exporter will go for forward sell, or you can go for money market hedging by entering into borrowing and depositing, or you can take a position in foreign exchange options where underlying is a foreign exchange, call option, put option, swap, foreign currency swap, and these are the ones. Forward for importer, forward for exporter, call option, forward exchange, put option, then floating to fixed, that is foreign currency swaps. Anyway, these are the things we already learned during hedging techniques, that is being just given in a summarized manner. So I don't think we need to discuss all these points. Okay, so then that is regarding Forex. Coming to international financial management, next chapter. So international financial management, they have introduced this concept of GIFT City, International Financial Center. In fact, there was a concept, there was a chapter in your previous syllabus that has been removed. Now they have added like the form of a topic, International Financial Center. So this International Financial Centers, in India also we have GIFT City in Gujarat. Company like Zerodha and all have set up their unit there. So when you want to attract multinational companies, telling that we will provide you world-class infrastructure in terms of roads, in terms of connectivity, internet, services, all the connectivity or any types of roads, buildings, connectivity, we will provide world-class service and you will be given the faster benefits of starting up a unit without going to regular route. You don't have to go to MCA, a regular application form. You will be given special privileges. Even tax benefits also will be given. Income tax benefits will be given. GST benefit will be given. Fast track registration mechanism. So by doing all these things, you can attract the foreign companies starting up the unit in the local place. Like in India, we have GIFT City in Gujarat. So that is the concept of International Financial Center. Even Zerodha have set up a unit over there. Lot of tax holiday also will be given. So opportunity for qualified professional working outside India and practice the profession. So it is like it is in India, but quality is beyond India. It is like high class quality. Now popularly people set up their business in Dubai or in Mauritius. So we can tell those, why you go there? Come to GIFT City in Gujarat. We will provide you world-class facilities and connectivities. So the foreign capital will come in. Professionals need not go to US to provide the services. They can provide the services, setting up the units in IFC, stop brain drain from India. So intelligent people don't go out, especially our IITians, after consuming all the benefits, don't go and develop the companies outside. Constituents, good infrastructure, stable political environment, strategic location, quality of life, sustained economy. In India, we have Gift City in India, that is also an SEZ, that is in Gujarat, I told you. And regarding Gift City, they have given that. And one important point I should tell you regarding Gift City is trading of Nifty. Outside India, we used to call it as SGX Nifty, Singapore Nifty. Nifty future in India, you know the timing is 9:15 to 3:30. And different countries will happen at different times. But what in Singapore Stock Exchange, there used to be one thing called as SGX Nifty, which used to run throughout the day, barring for a couple of hours of rest. Now that SGX Nifty has been moved to Gift Nifty. The Nifty now trading in Gift, the stock exchange happening over there, and that will run day and night. And many traders have observed at 9:15 whether market will open high or not. Now they look at Gift Nifty and based on that they assess, oh, Gift Nifty is trading at 100% higher, so today market is likely to open at a higher point. Like that they will use. So this is regarding the international financial sector, a small topic. Then we have foreign funds. Sovereign funds, sovereign wealth fund. Throughout the countries, just like the corporates invest, even the government invest. In fact, one of the largest funds in India, if I do a Google search, not India, largest funds in the world, if I do a search, you see, Norway Government Pension Fund, China Investment Corporation, Abu Dhabi Investment Authority, you can read, right, those elements. So, just like the individuals invest, like the corporate invest, government also invest outside their respective countries. Like Abu Dhabi Investment Fund is one of the largest. They invest in various funds throughout the world. They are called as sovereign funds. So funds who manages the government money are called as the sovereign funds. Surplus received from state-owned natural resource, bank reserve, foreign currency operations, money privatization, government transfer payments. So all these people manage the money, invest in basically money market, short-term investment, but sometimes they do invest in little bit of risky investments as well, risky securities. So they have like stabilization fund, political strategy, benefit pension reserve funds, and various types are there. They can invest money just like individuals and corporations. So that is about basically sovereign funds. So these are the topics they have added in foreign exchange risk management and international financial management. Coming to the next chapter, interest rate management. The topic that has been added is benchmark rates. And benchmark rates is not uncommon to you. We have discussed that as reference rate. See, for example, when you talk about the forward rate agreement, FRA, or even interest rate futures or options, captions and all we discussed, we need to compare that with the market rate, right? If the market rate is high, call option is exercised. If the market rate is less, put option is exercised. For the shares, we have the market price. And for the interest rate, we have the market rate. And market rate, we call it as reference rate. That's what is called as benchmark rate. For the purpose of settlement in interest rate management, in the interest rate derivative like forward rate agreement, interest rate future, we need to compare with an underlying interest rate called as benchmark or also called as reference rates. Typically, we used to use LIBOR as benchmark rate, London Interbank Offer Rate. But somehow people thought that is not reliable, that can be modified. People can change for their advantage purpose because it is between the interbank and it is not really the actual rate at which it is borrowed or invested. So different people have come up with different types of reference rates. We call it as we call it as alternate reference rates. Instead of LIBOR, London Interbank Offer Rate, we use alternate reference rates, which are different from LIBOR. They can ask you differentiate between LIBOR and ARR. ARR are based on actual overnight transactions. LIBOR is unsecured without any collateral, and whereas ARR, alternate reference rate, is the actual rate at which the borrowing for an overnight fund. So that is for a shorter period of time. ARR are also considered as near risk-free rates with no term premium because it's overnight. It's not for a longer period of time. So there is no term in time premium being involved. So different regions have their own set of reference rates. For example, UK has sterling overnight index average, SONIA. USA has secured overnight index. In India also we have MIBOR, Mumbai Interbank Offer Rate. So these are the things. In India we have repo rate, prime lending rate, MCLR. They are all used as benchmark rate or reference rates. So not much of complication, only one small topic being added, which you are aware of it. So no further discussion required here. Okay, so coming to the next chapter, business valuation. Quite a few topics have been added, but there is not much to discuss over there. The topics, whatever have been added, have related to valuation of certain situations or certain category of companies. Like if it is a distressed company, like let's talk about Reliance Capital. Mukesh Ambani is doing well. Anil Ambani companies, AG companies are almost going to be closed down. Or when you talk about Satyam case happened, and during that Satyam situation, Tech Mahindra acquired Satyam. So when the company is in trouble, like now Baiju is in trouble, maybe somebody can buy that. So distressed companies, trouble companies, winding up companies, in the process of liquidation or winding up, how do you value them? Startups, they don't have any historical data to do it. New age companies like artificial intelligent companies now, how do you value them? Digital platforms, a platform business like Swiggy, Uber, professional consultancy firm companies, or ESG, that is environmental, society and governance on valuation. So certain special situations have been discussed here. So we are not going to spend each and every element in discuss in detail. I'll just give an overview. Let us take one by one. So distressed companies, like I told you about Byju's, now they are in trouble. They may be because of debt or legal issues, or even see Paytm. Also maybe you can say to an extent distress. The company's license has been cancelled by RBI. So in those situations, when company is in distress, company is unable to meet or difficult in payoff financial obligations, and then one person acquire, that is the situation where valuation of distressed companies coming into picture. The issue with respect to distressed company is if I talk about discounted cash flow, terminal value is a challenge. What is terminal value? We will estimate the cash flow for n number of years, after which we assume growth will stabilize. Now it is a distressed company. Where is the future for the company? So terminal value becomes a challenge. Or they can have a negative DCF also. The cash flow can be negative. So in those cases, what methods are suggested? Modified discount cash flow. Modified means instead of going for estimate cash flow, you go for expected cash flow. Scenario analysis. Optimistic, most likely, pessimistic, take an average. So rather than going by cash flow method, sales minus fixed cost, rather than going by that, you can go with probability approach, scenario analysis. You can even do Monte Carlo simulation technique. And cash flow can be also calculated as 1 minus probability of distress. That's what I told you, using the probability approach. And even the discounted cash flow, instead of using terminal value, you use distress value. Like the company is likely to run for 5 years, and after 5 years, if company don't have value, the scrap value can be sold for certain price. Rather than assuming a continued value, you can assume a distress value in place of terminal values. So that adjusted present value model, where you adjust for tax benefit, unlevered firm to levered firm, those adjustments you can do. Relative valuation, take the EBITDA of the company, similar companies in that industry, take a multiplier and calculation based on that. Anyway, so this is regarding valuation of distressed companies. Coming to valuation of startups. Startups are one of the difficult one. Traditional methods cannot be applied because they don't have a historical data, and that is why startups don't get funding from banks. They don't have data to project. You can do projections, but where is historical data to back up your stories? And uncertainty exists. So if I follow income approach, we don't have income stream. If you follow asset approach, that is difficult to value. If you follow market approach, new age startups are disruptors like artificial intelligence. How do you do valuation? So we go behind something called as value drivers. What is the problem the startups are trying to solve? Go by that approach. You can go for the product, what they have, what is a unique product, how many customers are likely to come. So you don't calculate profit, you calculate what is the revenue from every user, how many users are there. I was part of various venture capital discussions earlier. So when they're funding, they never ask what is your revenue, what is your profit, tell me how many users you're going to get. So product basis, what is the management qualification, their background, their history, revenue, of course how much they have to generate, demand, supply. So those points will be considered. For valuation of startups, certain people have recommended, like Barker's approach, an American venture capitalist. So he has come up with certain methods. He came up like looks at valuing startup enterprise on detailed assessment of key factors, basic value. That is, if this company generate minimum cash flow, how much would be the value of the company? Then you attribute because of technology, how much value can be added, and by execution of certain plans, how much can be added. Then production and sales, like you divide this into various components and value them separately. Easy to say, difficult to apply. Cost to duplicate approach, or you can also say replacement cost approach. If somebody has come up, for example, you say Swiggy has developed a product. If somebody has to replicate their product, how much cost they have to incur in research, in development, in acquiring customers, like that. That is called as cost to duplicate approach. Comparable transaction method, that is relative valuation. If you talk about Swiggy, similar valuation I can talk on Zomato, what premium, what their command, things like that. Scorecard valuation method. Scorecard valuation means you do valuation based on different methods, then do a weight. Then you do a strength of the team, size of the opportunity, product of the service, that is by giving respect to the revenue, giving respect to technology. So taking different bases, arrive at different values, then take an average by giving the appropriate weight as balanced scorecard approach. Other approach also there, a first Chicago method, scenario analysis method, best case, worst case, optimistic, venture capital method. They go by if we have to get our investment into 10x, 20x, by 10th year our revenue should be so much, and if revenue is so much, the valuation will be 10 times of that, and today how much should I invest, doing a present value approach on those lines. Anyway, different methods are there, you can go through it, but broadly the challenges with startups is that they don't have historical data, and therefore traditional method may not be justifiable. We have to take a modified approach. Few approaches I have quickly covered. Coming to digital platforms, I think the current day world is about digital. A platform, Facebook is a platform, Swiggy is a platform. I think all new age business you're talking about is new different types of platform. Redbus is a platform. Anyway, LinkedIn is a platform. So with respect to platform business, how the valuation will happen? Marketplace like booking.com, Amazon, search engine like now, even artificial intelligence, there have been lot of rivalry happening, competition between Microsoft, which is OpenAI. Microsoft is backing OpenAI, and Google is coming with its own artificial intelligence thing, but it failed and they're rebranding themselves. Repository like YouTube, digital communications, even something like a Dropbox, that is also a platform, cloud, payment platform like Paytm, GPay, these are all applicable with respect to, these are different types of platform business that can happen. What method you can do? DCF method, regular method, market approach, that is valuation multiple, EV to EBITDA method, price to earning ratio method, or cost approach, cost duplicate. I told you, if somebody has to replicate this, how much money to be incurred, those kind of things. I can also add one more point based on revenue per user, or how much is the user growth, how much each user contributes in the form of revenue, what is customer acquisition cost, CAC. Those are the things can be considered even in valuation of startups and valuation of digital platforms. So moving on to valuation of professional or consultancy firms. So what is the specialty regarding the consultancy firms? They don't have materials, they are mostly service oriented companies, like a law firm or even CA firm. Like if one CA firm want to acquire another CA firm, so how do you value them? I think that is in regular approach only. But only certain things you have to be very careful, especially when you acquire, let's say, sole proprietary firms. Applicable for this also, applicable for doctor, lawyer firm, CA firm, CS firms, anywhere. So when you talk about the CA firms, you look at the income tax returns of the individual maybe, and you acquire that firm. But remember, the person cannot pay himself salary. It will be under profits. But when you acquire a consultancy firm, somebody should work for it, right? When it is self-employment, you don't pay to yourself salary. But if another firm acquires, somebody should manage, and for that you have to pay amount. So while valuing a consultancy firm, especially please consider whether imputed cost like rental, like if the person might be doing practice, he knows build in own building, he might not be paying rent, not showing rent, but if another person acquires, there is a rental payment. So imputed cost, such as rental cost, salary of the owner should be considered, and other things like key performance indicators, how many clients you have, are they specialization in any particular area, how many clients are there from how many years in the past, are they specific with respect to the people do they handle. Like we go to a particular hospital because there is a particular doctor. If that doctor is not there, I may not go there. So what is the loyalty level of customer with respect to particular people handling it, those things should be ascertained. So these are the points relating to valuation of professional consultancy firms. Then we have impact of ESG on valuation. That is E for environmental and S for social and G for governance. In fact, the most famous cigarette company in India, ITC, is on war foot of into diversification from the tobacco business to consumer products. They do have lot of consumer products like grains, food items like chips. They are diversified, but still their majority profits comes from tobacco business. And every time budget happens, which product gets the maximum tax? Tobacco. And ITC company used to suffer. So they wanted to change that. They are still not achieved, but they are in the process of it. Even ITC hotels, ITC 7-star hotels, 5-star hotels are there. They are in the process of diversification. So they want that impact. So some people say if it is alcoholic companies, we don't want to invest. In fact, when I was part of a wealth management firm, some clients used to say, don't buy for me any sin companies like tobacco business, McDowell's, alcohol business, ITC, Godrej, like Godfrey something is there, I think. They said don't have these companies in the portfolio. It's okay, I want to lose, but I don't want to invest. So those are the impact, and some people would like to invest in electric companies because they are doing good for society. We would like to invest. So social, environmental, governance. Some companies command premium because of their corporate governance, the decisions what they have, policy what they have. Like Narayan Murthy recently in an interview also told, I did not took my wife Sudha Murthy as part of a co-founding member for Infosys because I thought in the corporate governance the family should be kept aside. Whether right or not is secondary, but they always stand for certain principles and values. Like some people might say, we don't want to give the employment to any people who are from or who are having any criminal background, or we have a zero bribe policy. We will make sure that all the related party transactions are in detail information available. So corporate governance, some people take initiative. We also have this concept of integrated reporting. Some people have adopted, some companies like Tata Steel. They say we don't want to just perform or report financial statements. We want to report non-financial statements, intellectual resources, human resources, natural resources, how it is being utilized, what is our status, what is our future plans. So environmental, social, governance, those impact to what extent the company is utilizing, what is the company's approach towards these factors are also taken into consideration during valuation. Anyway, those points are there. I don't want to go to case studies and all, that you can go through it. Anyway, these are the amendments relating to the business valuation, basically the corporate valuation chapter. So mergers, one small area has been added, unlocking the value through mergers and acquisitions and business restructuring. Unlocking the value, taking the value out. Reliance was a holding company. Reliance Jio was a subsidiary company. Reliance Jio was part of it. Now they made Reliance Finance, financial services, into separate company, and they became listed also. So by demerging, even ITC is planning to demerge. So by demerging, what is a segment, a part of the company, when you make it into a separate company, its value can be explored, analyzed. The market value of those can be put into test. This unlocking the value is one topic that has been added through restructuring, within the segments transferring from one to another through various combinations. The value can be unlocked. Merging subsidiary, merger of an export oriented trading company. Even Vodafone Idea has to face competition, so they came together. You know, types of merger: horizontal merger, vertical merger, conglomerate merger. You can diversify the business, so the value can be unlocked. Business restructuring helps company in positioning the company to be more competitive, surviving adverse situations, and positioning in a new direction. Anyway, different points are there. A small section, nothing much to discuss. Overall, through merger, acquisition, and demerger, certain value can be unlocked by better utilization of resources, facing competition, unlocking the value or the putting it to the test, and making it to a separate management through diversification, diverse management, things like that, or professional management like that. Anyway, so that is one point added, unlocking the value through mergers. So nothing much to expect from that area. As far as the startup finance is concerned, they have added this concept of unicorn is a popular term these days. If you don't know the meaning of it, unicorn means a privately held company, not a public company, not a government owned company. A privately held startup should have valuation startup exceeding $1 billion, approximately in Indian terms 8,000 crores. Yeah, 8,000 crores, approximately 8,000 crores in valuation. That is called as unicorn. Many companies in India have reached it, and day by day it has been increasing, and they have given the list. I'm not sure why they have given Flipkart, Inobi, Musigma, Ola, Paytm, Quicker, Zomato. I think Byju's is also there. Combined valuation, Zerodha, Gupshow, No Broker, ShareChat, Zetwork. I happen to do one work for them. Yeah, so many companies are there. Day by day it is increasing. I'm not sure why they have given this list. I don't really expect you to remember the names of the company. So basically it is trying to say we are now at a global level having world class companies, and we are also coming up with the startups. Ideally, India used to be something like only a BPO country. We were just service providers. Now we also have become pioneer in startups. So we have unicorns to prove that. Valuation crossing $1 billion, approximately rupees 8,000 crores in valuation. Again, there is nothing much to discuss there. Succession planning in business. This is one of the areas even you can look for your practice in a family owned business. In a first generation business, if you are servicing, you will not have this issue. But when a business is run by family owned persons, in fact in many business in India are family owned, who will take over next? Because one person will be there, wife, children's, sometimes he will have multiple wife also, You can look at some political parties. So if you look at Raymond, recently I have saw some news that Raymond owner have been thrown out by his own son. He did not have enough legal practice and systems and authority for himself. He was given the treatment. So, and also when you are looking up to the clients, for you to retain the client for next generation, it is important you build a rapport with the businessman, their family. I mean, build a rapport, I'm not telling don't go to their functions and all. But do tell the clients, please involve your next generation in the discussions, be it income tax discussion or strategic discussion or bank loan discussions. Thereby they get the experience and handover can happen. And when it is done by a family head, he will be an experienced person. The next generation people would not have seen that the sufferings. So for them, you may tell the clients, please ensure, tell the future generation to come to your place, ask him to take first-hand experience, let him understand. In fact, Mukesh Ambani told in one of the interview, on the first day he went to office, first day of his work. He was given chamber and all, he went there and sit and he asked his father, Dhirubhai Ambani, what should I do? He said, you are an entrepreneur, figure out yourself. That's best lesson even I can share. The best learning is how to learn, explore yourself. And that needs time. Imagine suddenly if the person passes away, now the family cannot run that business. They may have to be sold at a distressed price and people will take advantage of the situation. So you have to take part in the succession process. Why there is a need for succession? Risk mitigation to minimize the risk. Cause removal. The existing leader is capable of gross negligence. The next generation should take over, or should they look for professional people like Infosys? They believe in professional management. Their son, Narayan Murthy's son or any co-founder son did not take over. They went for professional management. Things like that. Talent pipeline. Keep the person ready. Parag Parikh Mutual Fund. If I have to give example, Parag Parikh was the founder and he groomed the next fund manager. Like I was also working with associated with one of the fund management, and the owner who started that one, he groomed another fund manager for about 10 years. And then he quit and this person took over. He was not a relative, but he identified the talent pipeline. Conflict resolution, and when things going right, the conflict will not come. Suppose the head passes away. 5 children are there. They say, this company is mine. Nothing is written in the will. Maybe will writing. Maybe a good area that you can even think of practicing it. Alignment of interest. Strategy can be leadership position. Define the authorities. Map the competencies required. So once you decide these are the responsibility, who should take care? Will the family people take care? Should we look for CA? Should we look for people with industry experience? So identify the competencies and then bridge the leader. That is grooming up of the next generation. Challenges, anyway, founder mindset might be different than corporate mindset. That is one issue I even have found. Ultimately, the company will revolve around the founder. If the founder goes away, sometimes even the client will not stay. So that challenge is always there. Premature for startups to implement. They are just starting the business now. Why will they think about the future of succession planning? But it is good to plan ahead. And founders are the face of startups, and when they leave, the employees can have a difficult situation. The clients can have a difficult situation. So people in the market may not value the companies as they used to be. Anyway, so these are the amendments and changes that have been added relevant for advanced financial